Good morning to all and wish you a very happy Independence Day. On this occasion, we plan to have a topic on another important independence, that is a financial independence. So, what is financial independence? In a nutshell, it means that the money works for you and you work for your satisfaction. We doctors doing our jobs and busy in our practices many a times neglect the financial calculations as we don't see us retiring anytime. Today's world has a lot of opportunities to create wealth, and with proper investments, you can stop working for money and start practicing the way you want and when you want. For this to happen, you have to first understand the basics and devote some time to gain the necessary knowledge. In today's program, we have invited the experts from the industry who will help us in understanding various aspects of finance. Our very own doctors would be there in panel discussion who will answer your queries and also will share their own practical experiences on their way to financial independence. Please post your queries in the chat box, and as the time permits, the questions would be taken up after every session. Team AMC truly feels that you would be benefited by this financial series. All the very best to you and a very happy Independence Day once again. Now I would invite our President, Dr. Sushmita Madam, to give the presidential address. Madam is a consultant pediatrician at Bombay Hospital, Global Hospital, ACI Kambala Hill Hospital, Apollo Hospital, Mumbai. She is a chairperson elect and immediate past chairman of Association of Pediatric Surgical Oncology, which is a section of Indian Association of Pediatric Surgeons. Welcome, madam, and over to you.
Thank you so much, Dr. Vikrant, and a warm welcome to all the faculty as well as the participants who are here with us today for this program. May I have the screen sharing, please? Okay. Can you see my screen?
Yes, madam, just go in the slideshow.
Yeah. I was just wondering if you can see.
Because... Yes, it's visible.
Right. Okay, so Fincon we have been doing for many years. It's not the first time that we are doing, but this Fincon is with a difference. And what the difference is what we are going to cover today. And what additional benefits we are providing, that also will be covered today. So whenever we look at anything for the future, we always have to base our projections on the past. So let's just look at what the finance in India and in our country, in our setup, especially for the medical professionals, have been. So if I compare this, it is a well-developed, an efficient financial system economy is like the blood circulation system of the human body. And it is vital for capital formation, wealth generation, and distribution in any economy, just like the blood circulation is crucial for the body's growth and survival. So financial system is broad-based. It is classified into three categories: the personal finance, public finance, and business finance. Most of the times we are talking about personal finance. Public finance is obviously not in our domain. But today we are going to also be introducing the business finance, which has never been done before. So now, how did this financial structure evolve? If we look at the pre-independence era, from the period of 1857 to 1947, it was a mixed bag. And there, the rebirth of modern financial system was done. And in this era, the financial system was highly informal, with the elementary financial market structures. And the intermediaries were taking some shape. Capital flow for long-term financing was non-existent at that point of time. Now, post-independence, the political leadership favored socialist ideals and undertook an approach of planned economic development. And here we saw a lot of new institutions, financial institutions with public ownership coming in, especially starting with the Reserve Bank of India, which was established in 1935 but nationalized in 1949. This is post-independence. In 1956, the Imperial Bank became the State Bank of India, and the political leadership nationalized 245 insurance companies and provident societies to create life insurance company, that is the LIC of India. In 1969, they nationalized another 14 banks. By the time it was 1980, they saw a repeat of the same story. Government nationalized few more banks, but this era was also witnessed with establishment of government controlled new institutions like UTI. We all know what happened with the UTI from 1964 onwards and the issues which developed with this. Now, legal structure also was modified, and there were some notable developments wherein there were some acts which were enacted. The Capital Issue Act of 1947, the Companies Act of 1956, the Security Contract Act of 1956, the Monopoly Trade Restriction and Trade Practice Act of 1970, the Foreign Exchange Regulation Act of 1973. And this really resulted in the financial system taking a diversified structure to serve the planned economic approach. And then 1990 onwards or 1991 onwards, there have been a wave of transformation. So here again, the Indian political leadership embraced the ideals of a liberal market economy. So this was now changing from a government or a state subject to a liberal economy. The adoption of this market-led approach started reduction in the state control over the financial system. And state also accepted that, yes, there is a need for reorganization. And then 3 new regulators came into the picture. SEBI in 1992, IRDAI in 1999, and PFRDA in 2003. This wave of transformation continued. And then we had in 1992 the National Stock Exchange, the operations of which started in 1994, Stock Holding Corporation of India, the ICI Securities and Finance Limited, which was established in 1995 but started an electronic brokerage platform in 2000. So security markets as part of the Indian financial system witnessed significant transformation under the purview of SEBI. And then there was another major change during this same period. National Security Depository Limited, that is the NSDL, was established in 1996. And the Central Depository Services Limited, the CDSL, was established in 1999. With this enactment of these 2 acts, DMAT, the dematerialized form of trading shares, transfer of ownership, has become very easy and simple, and it is even evolving as of now. So today, what we see in this resurgent India, we see a fairly evolved and a complex financial system. I am confident that the current structure of Indian financial system, which is well understood by our financial partners of Association of Medical Consultants, Finovate Financial Services, who are working tirelessly for medical professionals and for all our members, we can achieve the aim of prosperity for all, financial literacy for all, and financial freedom for all, which is the theme of this program today. With this, I would like to, ask Pranav to please play the national anthem for today, being Independence Day, and let us all stand in respect for our country.
जनगण मन अधिनायक जय हे भारत भाग्य विधाता पंजाब सिंध गुजरात मराठा द्राविड उत्कल बंगा विंध्य हिमाचल यमुना गंगा उच्चल जलधि तरंगा तव शुभ नामे जागे तव शुभ आशीष मागे गाहे तव जय गाथा जन गण मंगलदायक जय हे भारत भाग्य विधाता जय हे जय हे जय 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 हे
Jai Hind, Jai AMC.
Jai Hind.
With
Jai
this,
Hind.
I hand over the proceedings with our speakers coming in and giving you all the information that we have planned for. Thank you.
May we have the CV slide, please, Pranav?
Good morning, everybody. I am Dr. Vivek Dwivedi. Our first speaker is Mr. Shailendra Dubey. Mr. Shailendra Dubey has over 2 decades of rich experience across banking, portfolio management, estate and succession planning. His last assignment was as Vice President with Universal Trustees Private Limited, UTPL. In his tenure at UTPL, he worked closely with some of the large business houses in India and advised them on issues related to family business succession, family governance, wills, trusts, and other estate planning matters. He successfully set up from scratch channel partner business model for UTPL. He has been actively training teams of various banks and wealth management firms on estate planning and succession planning. I invite Mr. Shailendra Dubey to speak on wills and succession planning. Mr. Dubey.
Thank you so much, Mr. Dwivedi. Happy Independence Day, and thank you for organizing this. Thank you to Finovate, thank you to AMC. This is a great initiative. What I will talk about is how do we pass on our wealth to the next generation? What are the issues around that? And how should we organize our wealth in such a way so that the whole process of this transmission is smooth and dispute-free? So I will talk about wills. I will also talk about some of the other nuances or some of the other terminologies which are used when somebody does an estate plan. Next, please. So let's understand what estate is. Estate is everything and anything that one owns. So all movable assets, immovable assets, are digital assets. They are very critical. A lot of time we do not realize that all your Facebook accounts, all your digital wallet, cryptocurrencies these days. So all this comprises of your estate, and one should plan for how they should be passed on. So the whole process of anticipating and planning for this assets or estate is called estate plan. Okay, so let me put this question and probably you can answer yourself. Why do we earn? Why do we do business, or why do we earn salary? Why do we create wealth? What is the whole objective? Obviously, the whole objective is to provide for our living, provide for our children's education, retirement planning, maintain our lifestyle, improve our lifestyle. So, and that's why we create this wealth, and that's why we earn. Okay, but and this is a practical, and most of us, you'll I'm sure agree that most of the time it's only 50% or less than that we actually consume in our lifetime. And I've seen cases where 70, 80, 90% of the wealth created by individual is actually passed on to the next generation. So while we spend our whole life in creating and preserving the wealth, okay, but the wealth for whom we have created, that is most of the time 70, 80, 90% of your wealth, okay, that is the transmission piece. Many of us do not plan or shy away from planning, considering this as a taboo or just delaying it. I mean, the typical excuses are, I'm still in 40s, 50s. Why should I do it now? I do not have enough wealth. My family is in cordial terms. I need not worry about all these things. So these are typical excuses, and we keep delaying, and then eventuality happens, and then the legatees are left to run around. Okay, so when you create your wealth, you should also plan to pass it on. Okay, so while creating wealth, you earn, you buy insurance when you want to preserve, emergency fund, diversification, all this. And the last bit, which is the transmission of the wealth, which is what I will talk about. So there are various tools and there are various things which one should do so that the whole process of passing on is smooth and dispute free. Next, please. Okay, so what are the tools around that? How do one passes on these wealth? Okay, the first and foremost, and which I think all of us should do, is ensure that our accounts, our investments are held jointly as far as possible. Unless there's a specific requirement or there's a specific situation, try to have all the accounts jointly held and operated. And also nominations should be there. If it's a singly held, then it must be, that's mandatory. Even if it's a jointly held, do have a nomination, because let's understand, when there's a joint account or a nomination, the nominee or a joint account holder has immediate access to wealth. So which means that our legatees will get the liquidity, the much needed money which is required, and they while the whole process of claiming the wealth through legal process of either through a probate order or through succession certificate or whatever, that may take sometimes a year or maybe more. And if God forbid there's a litigation, then it can go for ages. So I've seen actual cases where money is there, but it is all breached. Okay, and the access is not to the legatees. So it is very critical that we ensure that the nominations and joint holders are there in the account, because as I said, they provide the immediate access to the fund and the legatees, and that's very critical part of will of the entire exercise. Will, I will talk about that. Private trust, I will probably touch upon that. That's separate subject altogether. Family settlement, again, in certain business families or even large families, this kind of family settlements are done where each individual, each legatee agrees how the wealth needs to be passed on, what are the terms. So go on to create this family settlement document. And the last one, and probably the most popular one, through operation of law, which means you do not do anything and the law takes over. And I think 95 to 97% of Indians fall in the last category, where we actually do not do anything and then the law takes over. Let's see what the law is. Next slide, please. Okay, so when you do not do anything, you fall under the first part, which is intestate. Okay, when you do not write a will, you fall under category of intestate. And when you write a will, you fall in the category of testate. Okay, intestate. So if somebody passes away without writing or giving proper instructions, depending on which religion you are and depending on how the marriage has happened, okay, this Succession Act will apply. For Hindu, Sikh and Jain, Hindu Succession Act applies. For Christian, Parsis and Jews, there's the Indian Succession Act. For Muslim, there's a Muslim personal law. So when I'm saying that you do not write a will, you're basically leaving it to the law to take over and decide how your wealth would be passed on. Let's understand. If a Hindu male passes away without any will, okay, his wealth will be divided equally between wife, children, and mother if alive. That's called class 1 legal heir. In case if mother is not alive, then between children and wife. In case no children, then wife. Okay, so it's an equal distribution which happens. Only when there is nobody in the class 1 legal heir, then we look at the class 2 legal heirs. Father, siblings, and other distant relative will fall under class 2 legal heirs. Similarly, in case of Christians, if there are child, then 1/3 goes to wife, 2/3 goes to children. And then there is a whole process how it is done. So if there is a legatee, lineal descendants, then go to lineal descendants, and even the parents go. Parsi, there is a share for parents also. Okay, so there's a distribution between children, wife, and a share goes to parents also. So this whole distribution may not be as per one desire. Okay, similarly in case of Muslim, again, there are sharers and there are residuaries. Okay, if children are there, then wife gives 1/8. If there are no children, then she gets 1/4. If there are son and a daughter, then son gets a share. Daughter will always get a half of that. So there's whole rule which one has to go by. And also Muslims can only will away 1/3 of their property. Rest 2/3 will go as per the Sharia law. Unless the marriage has happened under Special Marriages Act, slightly legal and complicated. I'll not get into that. But broadly, what point I want to draw here is that if you do not write a will, if you do not go ahead and convey how your wealth needs to be passed on, there's a law which will take over, and the law may not be as per your desire. Like one may not want the whole wealth to be passed on to the legatees or to the mother. He may want everything to be passed on to wife, and then after that to the children. Okay, so that's what the whole idea is. Okay, so what I'm trying to convey is one should definitely go write a will, make it clear how the wealth will be passed on, and also take certain steps so that the whole process of passing on wealth is smooth, and talk about some of the tips which one should take so that the whole process is smooth. Next slide, please. Okay, so let's understand what will is. Who can write a will? You have to be major and you have to be of sound mind. So that's two basic criteria to write a will. It's basically a declaration of your assets, which means that how do I want to pass on my wealth, what all my assets are, capturing all that in a document with two witnesses will ensure that the will is legal. Okay, it helps to address certain important issues. Like a lot of time I've seen there's a issue with the clarity of distribution, especially if it's a large family. So will obviously gives that all required clarity. Disputes, and we've seen that in India, I mean, a large number of cases, I'm told almost 65 to 70% of cases in the civil court are related to property and inheritance related matters. Okay, hence it is very critical that we ensure that we provide a clarity and these disputes are avoided. Yes, confidentiality. So what do you want? You can write in the will, you can just keep it in a sealed envelope and the whole thing is confidential. Okay, the will gives an opportunity to make provisions as per your specific requirements. So there are families who will have special needs children, or you need to provide for a child more. For all those kind of situations, one can capture in the will, one can clearly say how this will be passed on. Okay, so those kind of options are available. Something which is close to your heart, philanthropy, you can again do it through a will. If you do not do a will, this will not be captured, this will not be taken care of. Okay, so let's move to the next slide, please. Okay, some more important elements of will. Firstly, it must be dated, it must be signed. Okay, one must express clear desire what you want to do. So there has to be clarity. So there has to be absolutely saying that what are your assets and whom do you want it to be passed on to. Okay, there has to be some disposition of a property. You may not, I mean, writing saying that I just want this to happen, that to happen. No, you can include all that, you can include all your desires, but the will should have a property which needs to be passed on. And very important, it has to be attested by two witnesses. And that's very, very important. These witnesses need not read the content of the will before signing, but on the last page where the signature is done by the testator, that means the person who's making the will, the witness can sign there. And also a very important point here, the witnesses need not be, I mean, the witnesses should be actually present and they should see the testator signing. What I'm trying to convey is that we should not sign the document, send to one witness, it comes back, you again send to the second witness. That's not right. Witnesses as well as the person who's making the will should be present together, and that's when the document should be executed. Otherwise, in future, if let's say a court case happens, then the suit happens, and the witness is asked, is the person testator signed in the presence? And he being honest, he or she being honest will say, no, I only got the document. Then the whole exercise might get defeated. So it's very important that the witnesses are present while you are executing the document, the will. Obviously, it has to be owned. You can also include what you're going to inherit. So the language can be such that you can write that all the asset which I'm going to inherit, all the asset which I will get in future. But obviously, it has to be owned by you. That's critical part of it. Yeah. Next slide. Okay. Some more important point about the will. It need not be typed necessarily. Need not be stamped. There's no franking which is required. And not also it is not mandatory to register. Okay, two witnesses, signatures, will is valid. Registration is a option available, but it is very highly advisable that we register the will, because when we register a will, a copy of the will is at the registrar office. There's a witnessing happens there as well. So there is one more authority which has the copy of your will, and in case of dispute, this can be helpful. But having said that, it is not mandatory to register. Okay. Now, another important aspect of it, when you are making a will, one has to write who's going to be the executor. Now, executor is the person who is responsible for taking care of the will after a person passes away. That means executor is the person who will have a power to get the will probated, collect the assets, make the distribution, do all the compliance related work of the estate which is required, and eventually close the accounts. So it's very critical to appoint a right executor. The legatees can be executors, and most of the time I've seen that the legatees are the one who become executor, but many times where one foresees that there could be a dispute between the legatees and one may want to appoint a neutral entity, you can also go ahead and appoint your friend or a lawyer or somebody as an executor. That's entirely up to you. Nominees, we make nominees, and I was talking about this earlier slide. Nominees only hold the assets in the trust. They are not the beneficial owner, which means that while you may have made your one son as a nominee and the other son not as a nominee, but the son who is a nominee in that account is only supposed to collect and divide equally if there are two sons are the only legatees. Okay. Now, this is very critical to understand because a lot of time dispute happens on this, wherein the person who's a nominee considers himself to be the beneficiary. So just ensure that whenever a will is made, we try to either make nominee as also the beneficiary, so the whole process of distribution is easier and simpler, or there's a clarity and understanding that this is how the wealth will be distributed, which the will cover. You can write a will as many times. Your last will is your final will, so you have power to revoke that. Okay. As I said, the witness need not read the content. Okay, they only confirm your signature. Now, situations, typically there are complications, sometimes related to the divorce, sometimes related to the terminal illness. Okay, and there are certain specific objectives, so the detailing can be done. And many times when a person has a minor child, okay, we advise that you provide for the guardianship in the will. So in case if the person passes away while child is still minor, you very specifically write who's going to be guardian. Otherwise, if there's no clarity, then the whole process of appointing a guardian takes place, and that may take, unfortunately, a lot of time. So that's again something which one should ensure that it is part of the will if there's a minor who's a legatee. Next slide. Okay, some more point, and then I move to the important tips. Beneficiary cannot be witness. This is very critical. Then who can be witnesses? Anybody who does not have an interest in the will assets can be witness. Also, the witness has to be major and of the sound mind. Okay. Also, one should try and see that the very close relative of the beneficiaries are also not witness, because there are chances that this close relative of the beneficiary, in case of dispute, may side with the person whom he is close relative with. So as far as possible, we should try to make independent people as the beneficiary, because that's will ensure that in case of a dispute, this has been handled properly. Okay. But beneficiary can be an executor, which is what I talked about. So you can appoint your wife or a children if they are major as an executor. I've already covered this. All digital assets can be bequeathed, and digital assets are very, very critical these days. So when you're making a list, please do include these digital assets, especially in this era of cryptocurrencies. They may be of very high value. Okay. So that's very critical part of it. Your share in HUF. Now, this is something which keeps coming. A lot of people have a doubt on how does the HUF property gets bequeathed. Well, your share, if you are a co-partner, your share in HUF property, you can bequeath it through a will. Okay, but only your share. You may have contributed 100% into the HUF. But if there are 4 co-partners, you can only bequeath 1/4 of that. The rest 3/4, you will not be able to bequeath because that's not yours. That's part of the entire HUF assets. Okay, so your portion in the HUF, your portion in the partnership firm, okay, that also you can bequeath. But you cannot say that so-and-so person will become a partner in the firm. That will be only decided by the terms of the partnership. Okay, the partnership deed should allow that. But you can always say the financial part of the partnership firm can be bequeathed. Okay. So even we may say that this is my last will and this is my last testament. You can keep revoking it. You can keep changing it as and when you want. Okay. Now this is a very more for academic purpose, not applicable to most of us. The will sometimes can be oral, and this is only available to people in defense, in army, in emergency services, in situation where they feel that they may not survive, and then they can do an oral will in presence of 2 people around them. So they can orally say that this is how they want their assets to be passed on, and these 2 people actually become a witness, and that's valid. That's allowed in India, and this is more for academic purpose, right? Okay. So next one, please. Next slide, please. Yeah. Probate, this keeps coming in. What is probate? When this should be done? Registered will have to kya probate zaruri hai? Kahan probate zaruri hai? All these questions keep coming in. Probate is basically a process of authenticating your will through court. Obviously, it has to be done only after a person passes away. You cannot do anything before while the person is alive. Okay, so it's a process. So once a person passes away, if the property or the person who's written a will are staying in Mumbai, Chennai, and Kolkata, then the probate is mandatory. But having said that, a lot of other states and cities are now insisting on the probating of the will, because it basically ensures that the will is genuine. There is no further claim on the property, and it also protects the other party involved. Okay, so probate, as I said, it's a process of getting your will probated, wherein you go and apply to the High Court here. Then there's a whole process of signing the document, and the window for contesting the will is given. After that, eventually, these days around 6 to 9 months it takes to get the probate order, and once the probate order comes, then one can go and claim the asset and make the distribution. That this is why I was saying that make nominee and the joint holding, because you do not have to wait for all this in case if you have nominee and joint holders in your account. Okay. Next one, please. Okay, so I was talking about ways to organize your wealth. Okay, now this is a very critical and important part of it, because this is where if we do all these things, and probably the list could be bigger, I have collected some of it, the whole process of transmission then is smooth. First one I've already covered, nomination, joint account, wherever possible, must, and we should do that. Go back, check all your accounts if it is there or not. If not, immediately, please do that. Okay. Another thing is to prepare asset and liability register. Now, this is very critical again, wherein you list down all your assets. What are those unique account numbers? Who are the people to contact for? Okay. You prepare that list. Just think that in case if something happens tomorrow, okay, will my legatees, will my children, will my wife will be able to know where my assets are? How to claim that? Okay, because the most difficult part of probating a will, or if there's no will, then filing for the letter of administration is collecting the assets, knowing where all the assets are. And in the COVID times, I have seen cases where the untimely death and people and the surviving spouse is totally clueless. I mean, it's all in mobile. Mobile का access है तो email ID मिलेगा. Email ID से you'll be able to get the consolidated statement. You'll be able to get that. But if there's no access to email ID, then how do one get all this information? This again brings back to one of the point I was talking about, digital assets. How does one ensure that digital assets are also passed on or the access is provided to your loved ones? Okay, so there are various ways to do that. There are services available for that, data management, cloud services. Okay, or you can just share the password with your close ones. So there are these things which one should do. Okay, digitize all your asset. That is the next point. Nominate someone to access this after demise, because there are services available where all your digital assets can be kept on the cloud, and you can nominate, and this person whom you have nominated, your spouse or your children, would have access to all that. Okay, that's one way to deal with it. Complete all the legal property dispute in your lifetime as far as possible. Okay, because I've seen once the person passes away, the legatees are left with these court cases or this complicated paperwork, these incomplete documents to deal with, and it can be really time consuming, frustrating. Do not leave it to your legatees, because if you are the one who couldn't do it, then I mean, it is not fair to expect to them to do everything. Okay, especially the ongoing court cases as far as possible. I know it's very specific and there are so much emotions running around, but that's one important thing. Try to resolve these things. Okay, consolidate your properties and accounts. Over a period of time, people scattered all across their assets, various cities, multiple accounts, multiple properties. Okay, whatever you think is no more relevant now, liquidate that, close those accounts. If required, gift to somebody, sell it. As you grow old, probably one should consolidate, and that's the fair and right thing to do. And last point is plan for inheritance. Okay, this is something which keeps coming. When is the right time to plan? When should I write my will? And one of the physical conference I was attending, a person came to me and said, when do you think is the right time for me to write a will? I said, today. Then he started laughing. He said, today, okay, but I can't do it today. But genuinely tell me, is it 60s, 70s, when I'm in 80s? Is that the right time to go ahead and write my will? I said, whenever you do, just ensure that you do it one day before you die. Then he started laughing loudly. He said, okay, so you were saying that I know when I will die. Nobody knows when he will die. I said, that's why I said today. Because since you don't know when you're going to die, okay, so better do it today, because the other option is not practical, to do it one day before you die. So do it today, do it as soon as you can. Okay, it does not take too much of effort. With assistance of Innovate, and we can make it very simple, very easy for you. Okay, but all important thing is to take that important step and provide this whole asset which you have created to your loved one in a dispute and a seamless manner. Thank you. Happy to take questions, if any.
Hello. Yeah, Mr. Dubey, thanks a lot for the insight regarding wills where people are less aware. So we'll take a few questions which have come up on the Q&A and chat. So
Sure.
there is one question by Dr. Parthiv Sangvi, that what happens in case both the witnesses are no more at the time when the will is being read? So how do you deal with that kind of a situation?
Okay, so first thing to do is, in case if you figure out that the witness is not around, do your will again. Okay, that's the first thing to do. And in case if you're not able to do that and the eventuality happens, okay, then the courts will look at the other circumstantial way. So if there's one witness, then they look at one witness, question one witness. In case if both the witnesses are not there, then when it goes for a probate, then the other circumstantial evidence, other things will be looked at. Okay. And then it will be difficult to prove the validity if there's a contest in that. Okay. But the will still remain valid. Your will not become invalid just because your witnesses have passed away. It's just that the whole process of proving validity of the will become a difficult, especially if there is a challenge. Okay.
So I guess if there is a conflict in the situation, then it becomes a challenge. Otherwise, I think
absolutely
it's valid and we can go ahead with it.
Correct. It's still a valid will.
So there is a question regarding is husband and wife, in case of husband and wife, if they own the assets jointly, is it okay to make one will or do we have to make separate wills in that case?
So this is about joint will or mutual will. Okay, so mutual will is a will where husband and wife make two wills, but they pass it on to the surviving of them. Okay, so it's a similar will, or we call that as a mirror will, vis-a-vis joint will. If you ask me, the advice is to do a two wills, a mirror will, because in case of a joint will, both the wills, both of them have executed the will together. If one of them passes away, then the surviving spouse does not have a flexibility to make any changes in the will. Okay. And the will also not go for probate or anything. It will just remain as it is. Okay. Only when the second person passes away that the will go to the whole process. So it's actually nothing happens. It's a jointly executed document. Okay. And since there's no flexibility, since there is no option to make changes, it's highly advisable that you do two mutual wills so that on the demise of one of the spouse, it gets passed on to the surviving, and then on the demise of the surviving, it gets passed on to children, the legatives, whoever they are.
So a conditional will cannot be made that in case one spouse passes away.
Yeah, so all that can be made in the mutual will. Okay, all the conditional aspect can be put in. But when you're doing a joint will, okay, then you are binding the other partner. Okay, sometimes this could be one of the objectives. So then it's all right. If your objective is that your partner should not make any change, okay, in the will, then probably yes. Then this is okay. But many a times one may not want that because if let's say I make a will saying that after both of us, it goes to our children. But if my wife requires some liquidity or to sell something or to deal with the assets, then she cannot do it because it is both of us who have done together. One person is not there, singly it cannot be changed. Okay.
So yeah, we have a question from Dr. Kapoor asking what are the disadvantages of registering a will?
Actually, nothing. It's just that one has to go to registrar office, pay a few thousand rupees. That's the only disadvantage. One disadvantage might be applicable to some, that the copy of your will is now at registrar office. So if you have issue with confidentiality, and there are some people who have, okay, then probably you may not. Because if you feel that somebody may approach the registrar office, bribe and get a copy of your will, okay, then that's a risk. But then there are ways to address that. Like what we do is in Bombay, there are multiple registrars. If there's an issue like that, we tell them, let's register at, Kandivali, let's register at New Bombay somewhere. Okay. Or so the first step of finding out where the will is registered at to bribe itself will be difficult. Okay. So there are ways to deal with it. But having said that, that's the only disadvantage, I think, except for a small fees and physically going there. Okay. Otherwise, registration is highly advisable.
So there is a corollary to this question that if I have registered a will once,
yeah,
and after that, if I make few changes in the will, so which is more valid, the registered one or the new will?
The new one, the last one, whatever changes you made, provided there are two witnesses and it's properly signed, that's the valid will. Previous will, unregistered will, not valid. Just because it's registered, does not make it to be the final will. Any will done after that, even if it's unregistered, is a valid one. So answer is most recent will, if properly executed.
Right.
Hi, Shailendra. This is Jignesh here.
Hi, Jignesh.
So, yeah. So, if a person is in the age bracket of 30 and 40, okay, and he has made a will, okay, but
Mhm.
he's in a phase where he's accumulating, he's in accumulation phase where he's adding more assets, at regular intervals. So,
Sure.
after making a will, how often he should update? Is he supposed to make another new will, or he has to attach the fresh investments he has done?
Okay, the way to go about this is that we make a will in such a way that whatever assets you acquire, okay, even after you've written the will, it is included. So the language has to be such that that means all future assets, all residuary assets, all assets which are being inherited by me in future, okay, all assets which are gifted to me, or I have missed out anything in the will. So the language is such that it is going to anyway include, okay, even if you have left out. So one need not worry that because I have bought one property, now it is out of the will. No. The language is such that even that property, that asset will be covered. Okay. So if you're writing a will in 30s and 40s, it is good because that's where you need to give a clarity to your legatees. Okay. Because they would be probably young, 10, 15, 5 years old kids. You need a clarity for that. When you are 70s, your kids are already settled. Okay. Whatever they get from you is probably surplus. Okay. So it's important to do it in 30s and 40s. And but having said that, yes, every 3 year to 5 year, you can update it. Okay, there is a schedule of assets. You can just keep adding that. Okay, so but you need to again get the witnesses there because if you're making changes, you need to add or you do a codicil to a will, which is making a small changes in the will. Okay, if you there's a substantial change which has happened in your life, if you've acquired a large asset, if there is a change in distribution objective, then yes, you should go ahead and change your will. Otherwise, as I said, that will is absolutely valid the way.
Okay. Okay. Thank you.
Dr. Bhagali wants to ask
Yeah,
some
I
question.
wanted to ask one thing. If you make a will and register it, and later if you want to make amendments or you want to change the will, is it mandatory to register this will again? So after registration of will, can you change it? That's the question.
Okay. So if you have registered your will and you want to do a codicil, codicil is basically one amendment which is done to the will. Okay. Then it has to be registered. That means the codicil also has to be registered. But if you do not want to register, then you do the will all over again. Okay. But a registered will, any changes in and codicil has to be registered again.
Thank you.
Right?
Any other questions?
And we don't have too much of a time.
Yeah, I was just going to say that that what we could do is, Mr. Dubey, are you comfortable taking all the questions and answering them in the chat box itself? And we can proceed with the next session while you are answering, so that those who have written the questions, you can directly reply to them, and then we are also, giving them a reply, that way, not bypassing. So because this is going to be, this could be 3 hour session also. This
absolutely, yeah.
We won't really have that much time. So,
I agree.
This is introductory session kind of. So if you can please answer while we start off with the next session.
Thank you.
Sure. I'll do that. Thank you so much.
Thank you very much, sir.
Thank you.
Please accept your certificate, digital certificate. Now I invite Dr. Ritesh Agrawal to carry on with the next session. Dr. Ritesh Agrawal.
It's my honor to introduce CA Geeta Tolia. Geeta ji has over 27 years of experience working with leading consulting and international companies. In 1987, she qualified as chartered accountant. Geeta worked extensively with SMEs for the initial few years, taking care of financial affairs. In 2012, she took time off to pursue higher education and did a master's in leadership and strategy, and MSc, popularly referred to as Sloan Fellow, from the London Business School. This sharpened her knowledge by bringing a wide international perspective. So let's welcome Geeta ji, and she will talk on medical entrepreneurs and business finance, which is made simple and relevant.
Thank you, Dr. Ritesh, for inviting me and welcoming me to this platform podium here before all of you all. It's a pleasure being here, wishing everyone a very happy Independence Day. We had an extremely interesting session with Mr. Shailendra Dubey to understand the transmission of wealth that you have acquired in your lifetime, and how with the processes and the tips and the tips to be followed in doing that. Today, now in my session, under the aegis of AMC and Finovate, I'm going to take you through the wealth creation, or the first box which he talked about, the entire wealth accumulation, but a part of it which relates to business finance, and typically what we earn through earn from rendering our professional expertise. As doctors, you would either be practicing yourselves, or you may be operating clinics, nursing homes. You may be involved in a fixed capacity with some large hospitals rendering your specialized services. So no matter what is your process of wealth creation, the wealth accumulation part of it, insofar as it relates to our business finance, arising because of our professional expertise, how do we manage that? How do we maximize that? How do we make those critical decisions, financial decisions, which are so necessary every single day? That is what we're going to cover in today's session. I will take you through two separate parts of this journey in today's session. The first is more a little rhetorical, because I'm sure you're all facing or dealing with these aspects, but just for the sake of kind of bringing the entire discussion in perspective, I'm going to talk about the typical challenges, some of the financial decisions that pose a challenge, and why is it relevant to make these decisions in a certain set manner, right? This later part of the discussion for today, and that's the considerable portion of today's session, I'm going to take you through an aspect or a journey of how to deal effectively with these challenges, and certain tips that makes dealing with business finance decisions in a simplified manner, the way what I like to call made simple for me, for the medical entrepreneurs. Moving to the first part, you see, the relevance of financial decisions is something which is not lost on any of us. We are excellent in our professionals. As professionals, we are absolutely excellent in our field, whether we are specialists providing a specialist area of medicinal practice, whether we run clinics, whether we run nursing homes, whatever may be our field of expertise, we provide those services in a very professional and in a wonderful manner. But often what happens is that we tend to push away, and we push away financial decision making, or let our chartered accountant make those decisions. We say, we tend to kind of think that, oh, I don't know the subject. My CA tells me that this is more tax efficient, and so let me do a higher purchase of the equipment that is to be purchased, and I will not consider the other alternatives. So financial decision making is something that impacts our everyday activity, impacts our profession as much as your personal finance planning matters, or your post-life financial planning matters. The business financial planning ensures that whatever you earn is earned in the best possible manner, is earned with maximizing the profits, and is earned without having sustained losses. You see, nothing can continue with sustained losses. I mean, most issues, whether you have to sign a contract, whether you have to deal with paying your monthly expenses, salaries, maintenance contracts, AMCs, all the rest of it, or how do you price your services? These are all decisions which impact the longevity and the sustainability of your practice. If you continue to have a negative health and you go down that trajectory, you as doctors would be the first to point out that your longevity is going to be affected. You will die young. The same principle applies to business finance and your professional money as well. If you do not ensure that the longevity is created or good health is created in your financial matters, there will be a demise sooner than later. I will just take you through some simple examples of the kind of decisions which you are called to make every day in your business. You are required to make a lot of decisions. I mean, whether you hire additional staff, or you require, you need to cut down on your manpower at a certain point in time. What should be, when should you change the prices of services that you've offered? Everyone in your neighborhood has started to change. Should you change it at that time, or should you change it when your costs increase? When do you make those decisions? How do you make buy versus lease decisions? So there's a lot of cost benefit decisions that you need to be taking constantly. How do you make these decisions? That always poses a challenge. Pricing decisions are the next piece, which are a very big ticket item and need to be considered carefully. Why will you change your prices? When will you change your prices? Because all of these decisions continuously made in an inaccurate manner or not following the principles fully will lead to depletion of your wealth rather than creating more wealth. And we have seen that the last 18 months has posed such a big challenge and such an enormous pressure on the healthcare services and the entire medical fraternity. We can do with simplification of these decision making. Other kinds of decisions that impact you are what kind of a practice that you're practicing. And I will dwell on this a little more as we progress in this session today. What kind of a practice are you running? And therefore, what should your focus be? Should your focus be on reduction of costs or increasing your price? How do you make these choices? How do you de-link? Why is it important, and how should you de-link your personal finances from your business finances? That becomes singularly the most important and the messiest area that we all deal with. Most professionals, I mean, it is not just the medical fraternity, but most professionals deal with this aspect because the personal finances inevitably tend to get mixed up with business finances, and it is important to be very cautious and disciplined about this and de-link the two at all times. I will dwell on the reasons for that when we move further in the presentation today. Most of you who run clinics or nursing homes or any other practice will be very conscious about the fact that come end of the month, there is a pressure on your cash requirement because all your monthly expenses have to be met. The rent has to be paid, salaries have to be paid, your supplies have to be replenished. A lot of outflows take place at the end of the month or at a certain fixed point in time during the month. Cash flow planning, how do you do that? Finding simple ways to do that is going to be far more helpful when you're making these decisions rather than doing it as a post-mortem or trying to bridge gaps or waiting for your CA to give you this information, which may or may not come always in a timely manner. And last but not the least, what is your optimal legal framework? Should you operate as a sole proprietary practice? Should you have a partnership, LLP, a private limited company? What should be your model of carrying out your practice? So these are typically some of the questions which you need to constantly keep grappling with. You constantly need to keep dealing with. And how do you find the answers? Surely there must be something or some way that this can be done in as comprehensive a manner as possible. So that, before I move to the second part, I was just going to say that takes me to the second part. What I want you to kind of take away from today's session, and I'm hoping this is what you will take away, that you start building frameworks or a thought process which will help you make sound financial decisions. You can build your own model. I mean, while we do have models that we recommend, but you can build your own model as well for making financial decisions. How do you improve profitability? By focusing on all financial aspects, not just the relevant costs or the big ticket costs, but even seemingly irrelevant costs need to be captured when making financial decisions. Sometimes it is all the intangible costs. How does it affect your reputation by taking a particular step? If the reputation is going to be impacted, most of us will shy from making that decision, because it is our reputation that we put out there when attracting patients or customers to come and take treatment that we prescribe. Right? So knowing all of these costs, knowing the benefits that you can take, how do you control these costs and improve your profitability is what I'm hoping you will all take away from today's session, and also some tips on selecting the appropriate legal structure for your practice. With that, I'm going to move on to the second part of today's session, where I will cover ways to effectively deal with these challenges and some tips on making business finance simpler for professionals like yourselves. In order to effectively deal with these challenges, what is important is, first of all, to build a mindset. It is a discipline. I mean, go back to the time when you were studying medicine. It required a certain rigor, it required a certain discipline to be followed, to say that this is, if we are studying a certain stream of medicine, it required entire focus on that part of the body, so that you're dealing with the issues and challenges that come up in that part of your body. Finance, similar to that, has a similar approach. It is a very rule-based approach. It is something where you need to have a discipline and you need to be comfortable in dealing with all of these aspects. So take the time to understand the financial dimensions of your practice. What does your practice entail? What kind of costs and outflows does your practice have? Examine each of those very clearly, very carefully. What is the model that you're operating? That becomes important. Right? When you start looking at these costs, it's important then to understand whether these costs are fixed in nature or they're variable in nature. Fixed is something which happens with that regularity, time after time, say paying rent for your clinic. On the 31st of the month or the 1st of the month, you have to pay the rent no matter what happens. Okay? Variable will be you incur that cost only if you have provided that service to somebody. It is something which is incurred only if the income is going to come into you. So adopt a stepwise approach when analyzing your costs. You need to then understand the relationship between the costs that have been incurred and the benefit that you're going to derive. I will dwell on this particular point in a later slide as well, as to how do you establish that relationship and what should you consider when looking at making a certain decision and creating that nexus. So you need to isolate that part of your body. You need to isolate that decision that has to be made and establish the direct and the indirect relationship that your costs have to the outcome that is expected and all the outcomes that you can derive from that incurrence of that cost. Again, a critical aspect to be looked at is when examining the costs, Are they creating value-added activities for you? And if not, what are the ways to reduce those costs? Is it possible or is it not possible? Right? I spoke earlier, I'm going to emphasize again, it's very important to have a discipline to keep your personal finance and your professional finance absolutely distinct. And more so, what my friend Mr. Dubey spoke about, right? Your personal finances, you can definitely give away with your own free will as you desire. Your professional finance, if it's tied up in a partnership firm, if it is tied up in a private limited company, you have a limited flexibility in giving that out to your heirs. Right? But besides that reason of post life planning for that, even during your life, when creating your wealth, when you demarcate your personal and professional finances, you have complete clarity in what drives your practice. How do you control the pricing in your practice better? How do you control the costs in your practice much better and maximize and improve the profitability of your business, right? And wherever appropriate, have a far-sighted approach. I mean, that is typically what we recommend, because when you have a far-sighted approach, you don't get distracted by short-term losses that you might make. Because sometimes it is inevitable that you might make short-term losses before you turn the curve and start to make profits. I have this framework which I want you to imbibe and take away with you. Financial decision-making depends on these 5 C's of financial, on these 5 C's. What are these 5 C's? The first is costs. I spoke about it at length when we were in the earlier section. The second C is the customer. You are there to serve as doctors to your patients, your customers, and it is what your customer can afford to pay. It is what your customer is willing to pay. It is what your customer desires to pay that will drive a lot of your financial decisions. Community plays a very big role. I was reading a report the other day, and India still is way behind in the growth potential or the number of clinics and nursing homes that are required. The medical fraternity is looking at a cumulative annual growth rate of almost 180% year on year for the next several years to come, because we have not saturated sufficiently. It is not always the big hospitals who can have that reach. It is going to be these smaller clinics, smaller nursing homes, medium-sized nursing homes, which cater to the community in a much better manner. So what is your optimal size? How do you work within that community requirements? That impacts your financial decisions. What is the competition around you doing? And what are the circumstances under which you're making these decisions? Sometimes a distressed situation makes us take a different decision than when we are able to sustain for a longer period of time and survive during the COVID period. The circumstances were so different. No matter how expensive oxygen was, people were buying it at whatever price it was available. So it is circumstances which will determine a lot of your financial decisions as well. Take these 5 C's as the fundamental principles of financial decision making. Compare every decision against these 5 C's and see that you're meeting the criteria that you have set out for your practice. Now, before I move on, I'm sure a lot of you would be aware of these, the terminology which has been put up over here. But in order to holistically look at your business costs and knowing how to control those costs, understanding what is the optimal size for your practice that you need to have, understanding where do you break even, understanding the nature of practice that you're carrying out, right? It's important to understand some of this terminology which I have set out over here. I will go through a lot of these terminologies in the next few slides. What is the cost of your occupied beds? What is the cost of unoccupied beds? Are you conducting a cost leadership practice or a specialist leadership practice? All of us like to think, I mean, and we are all specialists in our own fields, right? But sometimes the nature of practice that we conduct may be better tuned to look at it from a cost leadership rather than a specialist leadership. And sometimes it's the other way around. So having that clarity is very important in knowing what it is that you can control and what it is that you should control in this. And what is the legal setup for your practice? Now, let's dwell a little bit more on understanding the costs. Many of you may be familiar, but just to kind of put the base and the foundation in perspective, your fixed costs, as you can see in the picture out here, is that straight line which generally will not increase over a foreseeable future, irrespective of the volume of activity that is carried out. So that will reduce per unit as the volume of activity increases. This is a relationship that I'm sharing with you, which is important to understand. Your fixed costs will reduce with the volume of activity that you carry out. Now, you can go back and look at all the costs that you are incurring and just kind of mark it only from your own curiosity perspective. I've put out one example over here that the rental for your clinic is more or less a fixed cost. Of course, if your volume increases dramatically, tremendously, you will need more space. So your rent will go up. But for the foreseeable future, you can take that to be a fixed cost. What else in your cost sheet are fixed costs? Identify that. Once you identify that, you create a baseline for the minimum volume that you must have in your practice in order to create better profits. Variable costs, that is the diagonal straight line which is going up, and with every activity that is, or every service that is offered, that line goes up in that same proportion, in a proportionate manner. So that is a cost that you cannot change substantially, and it will keep increasing with the increasing levels of activity that you carry out. What does that tell you? What is the relationship that you need to establish when you have these kind of, when you're dealing with variable costs? Inevitably, and your price of your services has to be more than your variable costs. Unless your price is set for your services, the price for your services is set higher than your variable costs, you will be making losses in your practice. Can you go back in your cost sheet and identify all those variable costs? I've given one example over here, which is your medical supplies, right? It could be many other costs which are sitting out there, which are variable in nature, right? And this has a linear relationship with the volume of activity. Then we deal with the semi-variable costs, which increase in a stepwise manner. So up to a certain point, they remain fixed. Beyond that, it's variable. For example, one nurse can possibly handle 10 patients. And if you have more than 10 patients, you're going to need proportionately more number of nurses in your clinic to deal with the level of activity. So can you identify those semi-variable costs, and what is the engagement relationship? I mean, to what extent are they fixed and to what extent they're variable? You don't need to do it in a scientific manner. Just a rule of thumb is sufficient. Now, when you understand these relationship of the different costs, the different types of costs that it has with the level of activity that you're carrying out, you are in a better position to know how you should be pricing your services, how you can improve your profitability. Where can you control these costs? Are there alternatives which can give you a better return than the incurrence of costs the way you are doing it today? Right. Moving on, right? Let me take you through an understanding of occupancy and non-occupancy of a facility. I spoke of beds earlier, but it could be of the facility in its entirety itself. Right? Costs are incurred. It's important to understand that costs are incurred irrespective of whether the facility that is offered is occupied or not. Right? So if that is a true statement, which it is, then your first step is to determine the cost of your idle or your unoccupied facility. How much does it cost you to maintain a bed in your clinic when it is not occupied? You still need to keep the place clean. You still need to have the sheets changed. You still need to have certain basic preparations ready at all times, so that when a patient comes in, the person can occupy that bed without having to you can't invent the wheel at that time. So there is a certain level of readiness which is expected when you're running a clinic. Right? So what is that cost of your idle facility? And then you will have additional costs when this facility is occupied. So when you have someone come in, there is the entire treatment cost which comes in, the doctors, the specialist doctors' visits that come in, the routine doctors' regular checkups which take place, the nursing staff which is going to be busy around the patient that has come in. So there will be incremental costs which need to be added over and above this idle facility. Can you build that relationship, and can you establish what is the cost of your unoccupied facility and your occupied facility? This is what is going to be important to improve the profitability of your practice. Now, moving on, most of us, when starting our medical practices, when starting our professional journeys, right, we are called upon to make all kinds of decisions. It's not always that you will have all the money that you require to do the way you want to, start your practice. You might be called upon to take loans. You may have to buy very expensive and costly equipment. So the choice of whether should you lease that equipment, should you buy that equipment, can you do it in a collective manner? Maybe 4 or 5 of you get together and do a collective purchase, and everyone has access to that equipment. What kind of a decision would you be making under those circumstances? There is this constant need to have a cost-benefit analysis, even simpler decisions, more everyday decisions. You need to hire, your practice size has come down and you need to let go of some staff. When do you let go of your staff? You need to hire more staff. When do you hire more staff? Right? So on and so forth. So every decision needs to be analyzed. Some you may just do it without really giving it a second thought because it's everyday decision. It really doesn't matter. So the cost is immaterial as compared to the benefit, but it is still a cost benefit decision. In this situation, what is important is you need to identify all costs relating to that decision. It is not costs at random. It is only all costs relating to that decision. And costs include tangible and intangible costs, right? So now if your decision is to buy a new equipment, right? In buying a new equipment, the clinic rent has no role to play. The cost of your clinic, the rent that you're paying for your clinic has no role whatsoever to play. But is the space in your clinic sufficient to keep the equipment? That certainly has a role to play, right? But I'm assuming you would have taken, you would have gone through those aspects, that The physical space is sufficient. But the cost of your clinic, the rental for your clinic has absolutely no role to play in that. What is it that has a role to play over here? The role to play over here is over what duration, if you're looking to buy it on an installment basis, over what duration are you looking to purchase that equipment? What is the outflow that you will have every month or every period or over this entire duration? So maybe you have quarterly installments, monthly installments, whatever it might be. So what is the total outflow that you will have? Suppose you paid it upfront, what is your total outflow? Therefore, the delta, the interest which is going to be inside it. Will you have a sustaining practice over that duration that you're wanting to pay the installment? You need to make a judgment of that. Sitting today, you need to make a judgment over 3 years. You are going to have sufficient cash flows in order to meet that obligation, right? So all your tangible and intangible costs need to be put down systematically and understand that this is the overall impact on you, your money, and your practice, right? And in return, what is the benefit that you derive, right? You might have a more advanced treatment that you're able to offer because of this. You may have a need because the community in which you are living has a significant recurrence of this particular ailment, and therefore this equipment stands you apart. It builds your reputation. There are many tangible and intangible benefits. You might have the tangible benefits will be identified in terms of the increased volume of activity that you will have because of buying an equipment of this nature. The intangible will be the reputation that you gain. So all of these benefits will need to be identified, put down a value ascribed to each. Compare the two and make your decision. So that is, it is a very systematic, isolated approach that you need to have when making these cost-benefit analysis decisions. Moving on, I spoke earlier, when examining your costs, you need to look at all the costs which add value or which increase benefit to your customer or add functionality to your service or other values which get improved, and identify those costs which are not value adding. Sometimes they're necessary because it's a taxes that we have to pay, the licenses that we have to pay. It's regulatory in nature, and you don't have a choice over there. Sometimes it's the custom of the place of where you are practicing your specialization. So if you have, can you identify all the non-value adding costs and see how best to curtail those non-value adding costs in a manner that improves your profitability? Moving on, I'm going to take you through some understanding of pricing. Earlier on, I spoke of cost leadership and USP leadership. What do I mean by that? Now, a lot of times you may choose or you may decide that you're a specialist in a certain field, right? And that's a rare specialization. So you're an oncologist, you are a very specialized gynecologist or any other specialization where your years of experience have given you a certain reputation, right? And you might choose to say that there is nobody in the city of Mumbai who provides this as well as Dr. So-and-so. That is a USP leadership. You are going to start selling your time over there. And when you are selling your time, you need to make sure that where possible, can you charge it? For various reasons, you may not charge it at a premium, and that's completely understood. But what is the pricing that you can get because of this reputation, this USP, this specialization that you have, this leadership that you have, right? So it's important to understand what kind of practice that you run. On the other hand, right, you may be running a nursing home in a neighborhood where possibly there are 10 more nursing homes as well. Here, of course, you can build a reputation, and that only if you need to get a treatment of this type, it is only at this nursing home that you can get it. But primarily over here, your profitability will improve when you keep your costs under control. Right? So it's a cost leadership in most of these situations. There is no universal law. Please understand that. I'm not prescribing a universal position. Everything is circumstance driven, and it completely depends on what the community, the competition, and the circumstances are. But by and large, that is how there is a behavior of costs versus price, right? Some of your pricing models would be cost plus. So in the second example, where you want to ensure that your clinic is profitable, your nursing home is profitable, you want to make sure that all your costs are recovered and you're earning a margin on that. So there is a cost plus approach that you would apply to it. But you may also be curtailed by what is the going rate price in the vicinity. If everyone else is charging only 2,000 rupees per bed per day, you will need to be very, very clear if you want to charge 3,000 as to what is the differential that you're offering to the patient and why they should pay that additional 1,000 rupees, right? So unless that clarity is there, you will continue to operate at the going rate pricing. Some of the other pricing models which you can consider is a penetration pricing, a skimming pricing. Bundle pricing is very popular amongst a lot of the medical fraternity, because you've come to consult your doctor for one particular matter. There will be follow on 3 other services which will be required. Pathological tests will be required. There will be some other tests which may be required, and so on and so forth. So you can do a bundle pricing in that situation, right? That if it is taken all together, you get this price. If not, you get this price, and so on and so forth. So you have different pricing models. You don't need to get lost with all these different pricing models. Pick up something which works well for you, and then start simplifying and analyzing your entire business finances in a manner that improves your profitability. Let me now move on to the last part of what I'm going to share with you today, which is the framework of the legal structure. Now, under Indian corporate setup, right, there are traditionally these 4 formats. Of course, you can have cooperative societies, you can have other collaborative establishments, but typically these are the 4 profit-making formats which are generally used: a private limited company, a LLP or a limited liability partnership, a standard partnership which is not limited liability in nature, and a sole proprietary practice. Very often, most professionals, medical professionals and other professionals, tend to practice as sole proprietary practices, because that's the easiest format to practice under. And you don't need any other setup, you don't need any other establishment, the compliances are low, and so on and so forth. So it is the ease of practicing which should define your format. That's one criteria. But more than the ease of practicing, it's so many other factors which have a role to play. The ability to introduce additional areas of practice, bring in economies of scale, rationalize costs. What format can lend the best for all of these decisions is a format that you should choose. So today, you may be coming from a certain specialization, but there is an associated specialization and you want to bring in someone else to nurture that area as well. then a sole proprietary practice may no longer be appropriate. You might want to choose another format which meets those requirements much better. Then any format, whether a sole proprietary practice, LLP, private limited company, there is a cost of maintaining that structure. So what is the cost of maintenance? If, again, it's a cost benefit analysis decision. If the cost is greater than the benefit that you get, then you go to a simpler model, else you stay with that. Purpose fit, we spoke about that. What is your liability exposure? I mean, one is, of course, the medical liability that you would have as practicing doctors. But besides that, should you have, what more liability would you have? Would you be exposed to under which format? That is important to understand. And the most important is your time distribution. What is the time that you will spend towards administrative matters vis-a-vis towards your practice? That is very critical. That's an intangible aspect, but a very critical aspect that you need to consider. I'm going to leave you here with this framework, which helps you understand when should you consider a sole proprietary practice, when you should consider a partnership, when an LLP, and when a private company, right? So, I mean, it's here on the screen, which I'd like you all to absorb. If you, sole proprietary practice is the simplest format, but it has the least amount of flexibility. The growth in that is restricted to just you as the individual who's providing that practice or who's undertaking that practice. It cannot grow beyond you. But when you know that that's all, you just are going to sell your time, you are the specialist, people ask you for your specialization at all times, maybe that is the best model, because you're not going to you don't choose to partner with somebody else in that. You practice or you carry out your profession only with your own specialization. But if there is more than you, I mean, you're coming together and offering a kind of a bundle of specializations or a bundle of areas of medicine, then it might be better to consider a partnership or an LLP. These days, LLP is a preferred alternative because it reduces or restricts the liability that you're exposed to. LLP, being a separate legal entity, you can start to use it for promotional activities, which typically as medical professionals, we are restricted from doing. Even as chartered accountants, we are restricted from advertising or carrying out promotional activities. But as an LLP, you can undertake those activities. Overall, there is a greater operational freedom that you have in an LLP. You also have that same freedom in a private limited company, but a private limited company is far more cumbersome to maintain. So unless you're talking of a large scale, a bigger scale, and something where, you know, you want to say you create a bigger hospital, 100-bed hospital, or planning to expand more, then it makes sense to have a private limited company. So the choice will depend on, again, the circumstances or the future growth that you want to establish over there. Of course, there are ways to kind of move from one to the other, but that's for another day. And with this, I would love to kind of wrap up, and I hope you have had that takeaway that I was talking about.
Thank you so much, Geeta ji. I've been working with doctors for the last decade or so. So a lot of times the hospital owners have raised these concerns that they're facing a lot of competition from the larger hospitals, and nursing homes as such is dying. And what I understood that finance was one of the biggest aspects where, you know, whether you are a cost leader or whether you are a specialist, how do you price and basically how do you bring your cost down, and how do you actually determine, like you rightly said, the price of an occupied or a non-occupied. So these were the questions which were you know, coming in all our discussions, and so we thought that it's really needed to get a session on business finance for the medical entrepreneurs. I will now invite Dr. Sushmita Bhatnagar for you know, the next part of your presentation.
Hello. This has been a wonderful session, Geeta madam. This is like a great insight. What I feel is, in my opinion, there are two types of financial attitudes. One is those who do not want to understand anything, do not want to study, do not want to apply the scientific principles related to finance in their personal as well as their business lives, and rely on others' opinions. And they take their opinions and then run their financial lives accordingly. And the second category is one who has gone into the depths of this science, and they have changed their lives for their own benefits as well as the benefits of the finance. Now, to shift from this first category, that is level 1, to level 2, there are two things required. One is to be a good student, and second is to have a great teacher. So who else better than sorry, we used to saying doctors, who else better than CA Geeta Tolia madam, who is an internationally acclaimed expert, whom we have taken us in our AMC and the Finovate partnership. And here today, we have been very privileged and honored to launch the masterclass, which is unique, unprecedented, and extremely valuable. All the business content, all medical practitioners. And to understand this, there will be 4 sessions on Saturday, Sunday. We had to do, earlier we planned all Sundays, but then we had to plan it for Saturdays and Sundays because of the upcoming festival season starting from Ganesh Chaturthi on the 10th of September. So we thought we should finish off the masterclass before that. So Saturday afternoons and Sunday mornings. So the details of this masterclass, may I hand over to CA Geeta Tolia to probably provide more details on the masterclass. Thank you.
Thank you, Dr. Sushmita, very kindly to kind of announce the masterclasses. I will just take you through a brief of what will be encompassed through each of these sessions. I mean, while we understood the principles and the framework of thinking today, but it is also very helpful, especially for the first level people that Dr. Bhatnagar talked about, right? To kind of to transform, to take charge, to take control of their business finances effectively and start to make that, bring about that change and improve their profitability. If we can just move to the next slide, please. So in session 1, where we have, we understand our costs.
Ma'am, you will have to share your screen. Yeah, I think it's working now.
Yeah. So in this session, the focus will be completely to get an in-depth understanding of different kinds of costs, the manner in which these costs should be categorized, and when should you consider a certain cost as a fixed cost and when should it be considered as a variable cost. As I mentioned earlier, there's nothing cast in stone. It's not fixed, because today what is a fixed cost may become a variable cost tomorrow. What is a variable cost may in certain circumstances become a fixed cost. So how do you identify those, right? What is the relationship and the behavior of different types of costs and how they impact your cash flows and your profits? We will go through frameworks of the types of costs. I mean, there is just an illustrative table on this slide that you can see over here. What are relevant costs in making decisions? How do you determine your cost of occupied and your unoccupied facility? And what is the cost per unit determination? Because the cost per unit will define and determine what is the optimal size of the practice that you should have, which we will cover in a subsequent session. This session will be done over a 1.5 hour period. All sessions are going to be done over an 1.5 hour, 2 hours period that we will be covering that. The second session is going to focus on pricing and doing, and the second part of it would be doing a cost benefit analysis. Understanding what you are selling. How will you price what you're selling, right? The costs that need to be considered in making pricing decisions. Again, the relationship of fixed and variable costs in making these decisions. Some pricing principles have been shown out here, but we will go into a lot more depth. I mean, what is shown out here is just a sample of what we will be covering. Then making cost benefit decisions, identifying the value of all benefits, value of all costs, and the interplay if there is a dynamic change that you're looking at. What if the benefit was to go up by a certain percentage and the cost was to increase by a certain percentage or reduce by a certain percentage? What is the overall impact on the benefit that you will have? And so these are ways in which we will address being able to take appropriate cost benefit decisions. This too will be covered over an 1.5 hour duration. All these sessions, mind you, will have adequate pre-reading and post session assignments, simple ones, which you can apply to your own situation and come back with answers which will help you take you into the next phase of your journey. The third session is really a very insightful session on break-even analysis. This is something all of us are always interested in knowing. What is the optimal size of my practice? If I have a nursing home which is 20 beds, is that appropriate, or should it be a 40-bed nursing home? Why am I always making losses? Why am I not able to make profits? The break-even analysis gives you that answer. Where in your practice do you break even? And in order to determine your break even, you will get detailed insights about the cost interplay, the unit costing of your practice, the price at which you must, the price that you must charge your customers in order to break even. Otherwise, the perpetuity over which, or the period of time over which you will continue to make losses. And this gives you that sharp answer. Great, I know my clinic or my nursing home must have a minimum of 35 beds that's when I start making profit. So if I'm at 20 beds, how do I make sure that I add another 15 beds so that I know I will start making profits? What is involved in that process? And the last session is on the legal structures. We got a glimpse over here today about the different formats and the base criteria, or the fundamental principles of choice, right? But in this session, we will cover in more detail about all the legal formats. I mean, specifically these 4, which are the profit, any business carried out for profit models, understanding through different lenses the efficacy of one type of legal format over another, from a taxation perspective, from a break-even perspective, from a freedom to operate perspective, economies of scale. So from different lenses, what is it that fits your bill perfectly is what we will look at. How do you convert from one legal format to another? Just an understanding, a framework of that, so that you know it is possible. It's not that if you started as a certain legal format, you're stuck with it for life. You can't change to another. Possibilities and options of consolidating and restructuring from one legal format with another. So this is what is the journey that we will take you through these 4 sessions in this masterclass. As Dr. Bhatnagar said, because of the paucity of time and festivals coming up, we have scheduled it for Saturdays and Sunday, starting very soon. So those of you who are interested, over to you, Dr. Nehal.
Thank you so much, ma'am. There was supposed to be a Q&A, but we are running behind schedule and we have
I'm
like
sorry.
other speakers waiting. And I do understand that business finance is a very in-depth topic. So I think people can just put their questions in the Q&A and chat. And ma'am, while you're here, you can just answer those questions. So all over to you, to the AMC committee.
My apologies, but thank you very much.
Not at all, ma'am. It was such a wonderful session and you have given such a beautiful insights. We are now more knowledgeable on this topic. Pranavji, I request you to please, So, ma'am, please request a certificate of appreciation from AMC. And it is a digital certificate. Sorry, we are not able to give it to you physically right now. For the next session, I invite our Vice President of AMC, Dr. Rajiv Agarwal, to please conduct the session. Dr. Rajiv Agarwal.
Yeah, sorry. Yeah. Hi, friends. This is Dr. Rajiv Agrawal. Let me introduce our next speaker, Mr. Nimesh Chandan. Am I audible? Hello?
Definitely, yes. Definitely.
Yeah. Who's going to speak on Mind and the Money? He is head investment equity at Canara Robeco Asset Management. In his role, he heads and overlooks the strategy for both domestic and offshore equity funds. Mr. Nimesh has more than 21 years of experience in the Indian capital market, of which 16 years has been in fund management. Under his leadership, Canara Robeco Asset Management Fund was awarded the best equity fund housed by Morningstar in March 2021. He completed his master's in management in 2000 and then specialization in finance. He has also worked with ICICI Prudential Technology Fund, which won the ICRA Award in 2006 for best performance in 1 year period for a sector fund. In 2007, he received the ICICI Group Leadership Award for leadership in organization capacity. Over to you, Nimesh, sir.
Hi, good morning, and very happy to be here among all of you on this day. I just heard Ms. Geeta Tolia talking about the structuring of the businesses and what is most effective, and I think
Nimesh sir, we can barely hear you.
is this better?
This is much
Should I keep the mic close to my mouth? Okay. All right. So I was saying that very happy to be in this seminar, and I just heard the previous session by Ms. Geeta Tolia, and even I found a few very interesting points to learn from that seminar. So I'll just upload my presentation. I have some few slides about investing that I've prepared for you. Are you able to see that screen now?
Yes.
All right. Fine. So actually, I'll be talking about investing, but talking less about markets and talking more about how to be a good investor or how to have success in investing. So this is a series of presentations I generally do called the Money and the Mind, which is talking about psychology behind investing and how temperament in investing and behavior in investing is more important than just gathering knowledge about various assets or securities. So the idea is to take you through quickly 3 short stories and 1 long story and 1 idea. So you can take this idea as a suggestion, or you can take this idea as what is a recommendation from my side. So let me take you through quickly. The picture that you see on the screen right now is a lady named Grace Groner. She was born in 1909, April 1909 to be specific. She started looking out for work in US during the Great Depression in the 1929-1930. She found a job as a secretary with a pharma company, and she worked for 43 years as a secretary in this company. She did not get married, did not have any kids. She didn't even buy a car. In fact, she used to live in an area. So the town was Lake Town, Lake Forest Town. But the area she used to live in was not a very posh area or where rich people stay. She lived a very normal and uneventful life. She used to do some charity for her school and for the children. She lived up to the age of 100. So she passed away in the year 2010, not very far away. She had written in her will that whatever assets she has, they be given to her school, Lake Forest Academy, to help give scholarship to students. When the principal, the dean of that school, received the check was for an amount more than $7 million, more than 50 crores. Now people started inquiring, how come this lady who's been just a secretary for so many years, how did she have so much wealth? So it seems she had invested $180 in stocks in equity markets in the year 1935. And whatever dividend she got or some bonuses she got, she reinvested back into the market. And that amount actually grew to $7 million. Now, this lady, as I described her life, you would know that she was not some super intelligent human being who created wealth from the markets, right? And here we find in the stock markets a lot of people who are born with a silver spoon, having the best of education, solving the best of complex problems in mathematics or accounting. But they are not able to create wealth. And in fact, during every crisis, they probably raise their hand and say that I'm bankrupt. So it is not the intelligence by which your mathematical prowess, by which you make money in the markets. To enjoy the magic of long-term compounding, you have to be a long-term investor in the market. And that's what will create wealth for you over a period of time. The second story is about a 25-year-old boy. So in 1952, a boy named Harry Markowitz, he was doing his study in linear programming, and he wanted to meet his professor to ask him what PhD topic should he pursue, what should be the doctoral topic for him. While he was waiting in the waiting room to meet his professor, he also met a stockbroker there who was also waiting. The stockbroker suggested to him, why don't you try putting this quantitative science into stock markets? The boy was very excited. He said, fine, I'll try that. He did not have any knowledge about the markets. So he said, okay, what is the good thing about the market? You get profits, you make returns on stocks. What is the undesirable thing? So he couldn't find what is the risk. So he put volatility as a risk. So returns are rewards and volatility is the risk. And then he wrote a nice paper on it, which after a few years actually got him a Nobel Prize. So Harry Markowitz, a lot of you may know, won the Nobel Prize for his paper on measuring risk and returns. Now, this topic of volatility was taken by other academicians and then put into various type of different academic studies about the stock markets. So volatility started being considered and put in textbooks as risk. On the other side, in 1954, Benjamin Graham, who's a guru of Warren Buffett, he wrote the book Intelligent Investor, which is considered to be a Bible kind of book for many fundamental investors. In that book, he mentioned that think of volatility as a guy named Mr. Market. Suppose you have a business and you have a partnership where Mr. Market is your partner. Now, Mr. Market has a tendency every day, he will come to your cabin and he will quote a price for that business. He will say, okay, I'm ready to buy your share in this business at X price. And I'm ready to sell you my stake in that business in that price. Will you buy or no? Or will you sell or no? Every day he comes and talks to you like this. Some days he is in a very good mood and offers you extremely high price. Some days he is very depressed and is willing to sell you his stake at a very low price. This is volatility or daily market fluctuations. only when Mr. Market or market volatility is quoting an extremely high price for your investments and willing to buy it, or quoting an extremely low price for your investment and willing to sell it, only then as an investor one should react. Now, the investors who followed Benjamin Graham, uh, guys like Warren Buffett, Seth Klarman, Howard Marks, all these investors, they made huge money. Now tell me whether volatility for a long-term investor, is it a risk? No. Volatility is a long-term investor's friend. That's when you can buy extremely good companies at fantastic prices. Now, let me come to the third story. A group of scientists under a guy named Paul Schlovick, they got together a few experts of horse racing, and they are called horse racing handicappers. But let's say they are experts in predicting which horse will win in a race. They got them together and they said, we do a study. Now, it is important to see the aspects of the study. They collected data about historical races, which means the outcome was known. They collected 88 data points about each horse in each race. But they told these experts that we will pick up a race. You can ask for any 5 data points about the horse that you think are relevant in projecting who will win about that race. So we will give you 5 data points out of those 88. So the experts did the first round where they took the 5 data points they thought was important about the horse and the jockey, and they made a prediction. And they were asked, how confident are you about this prediction? They said about 17%. When they measured the accuracy of these experts, it turned out to be 19%. So it's fair. They were 19% correct, and they were on an average 17% confident. So that matches very well. Now, in the second round, they were said, now you can choose 10 data points. In the third round, 20 data points. And in the fourth round, 40 data points you can choose of the information you need about the horse and the jockey to make your prediction. They made the predictions. They were asked, how confident are you? They put a number to that. Now, can you guess how their accuracy and confidence went? The accuracy, their predictive ability flatlined at 17%, but their confidence more than doubled. Beyond a point, the information that we collect becomes useless in improving our accuracy, but it just increases our confidence. And in the financial markets, this becomes extremely dangerous. When you are sure about something, when you're extremely confident about something, but your accuracy is low, which means actually that's not true, then you can lose a lot of money in investing. So rather than being obsessed with collecting information and ideas, beyond a point, information edge or just collecting information doesn't help. It is how you behave that helps. Now, a long story. Here we will visit a lot of Nobel Prize winners, hedge fund managers, academicians, mathematicians, scientists, and so on. So let me start this with a company called Long-Term Capital Management. During the late 90s, this was one of the best hedge funds. It had Nobel Prize winners who were doing arbitrage, basically, and creating a lot of wealth by leverage. A lot of Wall Street companies started copying them. Guys like Morgan Stanley or Merrill Lynch, they were copying them. The blue line here is the returns that this fund made in the initial part of their business. A little later, this happened. They lost so much money because none of their theories worked for a period of time. And in fact, people who copied them and had taken leverage to invest in the market also lost so much money. And mind you, there were Nobel Prize winners in this fund just doing arbitrage and lost so much money. Because the problem was they predicted that the markets will behave in a particular way all the time. And they went wrong. In fact, it was such a financial crisis during that time because so many companies and funds were affected, that when Federal Reserve, the US central bank, wanted to take stock of the damage, and they called all the bankers together, there were not even the number of leather chairs in the boardroom to get all these financial celebrities seated. A lot of chairmen of banks were sitting on foldable steel chairs. Now, let's move to the next story. We spoke about Harry Markowitz, who predicted the exact, who gave the theory of predicting the exact risk return of a particular security. A journalist asked Markowitz that, in your personal investment, how do you invest? So Markowitz said, well, I actually divide my investments 50-50 into equity and in bonds, in fixed income. Why? Because if I'm not invested in equity and equity market goes up, or I'm fully invested in equity and if it falls, it will pain me. I'll regret it. This is the person who calculated the exact risk and return of an asset. Okay, look at how the personal investment is done. Now let's move to mathematicians. Isaac Newton, I think one of the best minds that we had, could calculate anything, right? He was also an investor. He invested in a company called South Sea. He invested and he made money in it. Then some of his friends and relatives told him, no, there is more money to be made. Why don't you continue? So he invested again near the top of the market and actually invested more money. And when the stock price collapsed, he lost a lot of his wealth in that. This is a chart I found from internet about his entry and exit points. You can see. Let's come to economists. How have economists done in stock market? So Irving Fisher, economist at Yale, one of the best considered economists in the world.
Nimesh ji, may I interrupt you?
Yes.
Your little volume up is required because we're not able to hear you very well. It's such an interesting talk. And it's so wonderful. Yeah, if you can do
Okay.
about
Okay.
this is
Sure.
very good. Excellent. Excellent now.
Yeah, I think I would want to compliment him in his session. It's we just can keep on listening to all these stories. It's brilliant.
Thank you. Thank you so much. I'll try to be loud and I'll try to keep the mic. I don't know. I'm using my son's laptop. So maybe the setting is something I don't understand here. Okay. So, so Irving Fisher, like, one of the greatest economists in the world, when he was speaking about stock market, he said, stocks have now permanently reached a level where they will continue to go up. They will continue to enjoy high valuations. Unfortunately for him, he said this 3 days before the big crash of 1929. All right. In fact, Irving Fisher lost so much wealth. I've heard a story that while he was teaching in Yale, he lost so much money, he had to actually sell his house. And because Yale did not want one of their star professors to live in a rented house, they bought this house and actually gave it back to him to stay. What are these people getting wrong? They are fantastic minds in themselves, but what are these people getting wrong? George Soros, he puts it well in his book Alchemy of Finance, that if all angles of a triangle don't add up to 180 degrees, then any theory made based on that in geometry is useless. All these people thought that human beings are rational and created theories or trading strategies or investing strategies, assuming that economics and finance behaves like a science and you will get exact output for it or such and such input. And they lost a lot of money. Who got it right? Again, fundamental investors like Benjamin Graham. Again, I said, like in 1954, that book he wrote, Intelligent Investor. In the very introduction of that book, he writes that we shall talk quite a bit about the psychology of investors in this book. Because the primary problem or the investor's chief problem many a times turns out to be himself. And hence, discipline and behavior and temperament, psychology is more important in investing than any mathematical model or theory that you read. Now, I'll come to the idea. Now, if you want to do well in investments, what do people generally do? What is the source of alpha, as fund managers call it? Or how do you outperform? How do you do better than the others in investing? There are three sources. This is an interesting paper by Russell Fuller. He writes about these three advantages as an investor you can have. One, you can have an information edge where you try to collect information about business, about the industry, about valuations, and then you start applying them. Well, you will do well, but you will do well along with the crowd, because getting an information that is earlier, better than the what others have, earlier than what others have, consistently is very difficult. And it is becoming very costly also to get that information. I'm not talking about insider information. It is about studying businesses, because everybody is doing the same thing. The second is an analytical edge, where you are information everybody has, but I analyze it in a better way. I have a best quant model or best analytical model. This also over time gets copied by people. The third edge is the behavioral edge. The behavioral edge is about that even if people have the same information and the same analytical model, how they react is different. And here you try to take advantage when the crowd overreacts to a new situation or it underreacts to a new information. And you also try to make yourself so disciplined that your behavior is superior to the others. You resist, say, greed, fear, regret. You resist these and make a better investor by following a certain discipline. I believe the behavioral edge is one of the strongest and the longest sustaining edge that one has in investing. I'll end with a picture of a Wall Street trader. This is Lehman Brothers. If you see the trader, if you see in the picture on the top left, is looking at 4 screens, getting all the information, looking at all the analytical models. By the way, this is a picture taken before Lehman Brothers went bankrupt. And on the other side, you find one of the richest investors in the world, Warren Buffett. He's sitting and having a burger in his office. In fact, in his office, there is a tray. I've given in a small clip below in the picture, a tray that has a words written on it, too hard. Something that he doesn't understand, he puts in that. If it is too complicated to understand, he doesn't want to invest in it. He puts it in that tray called too hard. So following simple discipline, having the right temperament, thinking longer term, using volatility as your friend, these are the well-known secrets, I would say, about being a successful investor. Now, maybe I'll stop here, and Dr. Bhatnagar and Nehal, if there is any question, I can address those.
Nimesh, I would want to compliment you that in the 2 decades, I've heard a lot of fund managers and a lot of finance professionals giving, presentations on the topic of equity investing. But what this has really done is opened our minds as to how we are supposed to handle our temperaments in different situations. So it was really wonderful. And I think it was good that I attended your session today. And like we said, this is the first of the Financial Freedom series. We would want you to come back and, actually open our minds to new concepts and basically how should we handle our mindset in the different markets. All over to the team for question and answers.
Thank you, Nimesh sir. That was a wonderful presentation and a very simple and basic, very easy to understand for us, for everyone, I guess. So I'm assuming that the basic question which must be coming in everyone's mind who are investors here would be that currently the market is at 16,400 Nifty, which is all-time high. So people are speculating as to whether we should stay invested, invest more, exit this, or I mean, what would be the right decision? How do we go about taking that decision?
So many a times people look at the index level to decide whether to invest or no, and try to time the market. Frankly, that doesn't lead to much gain, because the index level tells you very little about what the businesses are doing and what the market is doing, and what valuations these companies are trading at. Many a times, even the average index valuation, they hide more than they reveal. So I would say, when you are thinking longer term, plan your asset allocation in such a way that you reach your financial goals uh, despite all the volatility that will come in. Always focus on the longer term. Timing the market requires a lot of study. Uh, if you can spare that much time to really understand or completely understand the market valuations and the business cycles, then you can do that. But otherwise, have a financial advisor that can help you, or an expert that can help you to manage your investments. Uh, it is very difficult even for financial professionals to say that what is the exact top in the market and what is the exact bottom in the market. It is always important to focus on the long term. Yes, there are times when the market corrects, you try to allocate more towards equity at that time. There are times when market is really expensive. At that time, you can decide to take money off. But if you are not giving it so much time, then don't do it just by your own. Take some guidance into it. Now, just to give you a perspective about the current valuation, because a lot of people want to know what the market valuation today are. Let's say pre-pandemic. So in January 2020, the Nifty was at 12,300. And uh, from there, in 1.5 years, we have come to 16,300, which is about 32% increase in the market price. Now, within that 1.5 years, the earnings growth, the Nifty companies, those 50 companies had an average weighted earnings growth of 16%, which means half of the market move is justified by what has already been delivered, that is the profit growth of those companies, and half is a re-rating based on expectations about the future. Now, what are the expectations? That this year, that is FY22, March 22, the earnings of Nifty will grow by 30%, and in the next year, it will grow on top of that by 16%. That is the expectations that we are going with, which is actually a very good growth rate and which justifies that higher valuation. The price to earning ratio of Nifty for FY23 is 20 times. It is trading at 20 times multiple. Now, here also, it is very difficult to compare this in how it was trading at the last decade, where it exactly tops, exactly bottom. But yes, at this point of time, there is optimism in the market, and hence it is trading towards the higher side. But with growth coming in, as you are invested for the next 2 years, the same thing will be realized in profits and the valuations will justify themselves. However, I would still suggest for individual investors, either have a systematic plan like an SIP for investing, or take guidance or your asset allocation from investment professionals. The two things, if you keep in mind, that focus on long term and use the volatility, then at the end of the period, you will not worry about your reaching your financial goals. You will reach them.
Yes. Thank you so much for that very valuable feedback. There is just one question asked by one of the participants, is that what is it preferred, whether active fund investment or a passive fund investment? What do you suggest? So what is more preferred way of investing?
So there are positives and negatives on both sides. So there is something that I would say a balanced approach is better, rather than just going by whether I'll be only investing in active or in passive funds. However, uh, whatever you choose should ultimately lead you to your financial goals. Uh, take advisors who can help you understand your financial goals and the journey, and then appropriately put your allocations. That's what I will say. Some people who are doing it on their own, again, it requires a lot of study to see. There are a lot of options today for investors. Within mutual funds also, there are huge number of options to choose from. It is better that you have either complete knowledge about them or you have somebody. So as you say, either you know jewelry or you should know a good jeweler. So that is how you should approach it.
Yeah, there is one more question regarding comparison between regular mutual funds and direct mutual funds. So what's your stand on that?
So again, that's the thing. When you're going direct, then you do your own study, okay, or pay a certain fees to an advisor to help you invest directly by choosing the right fund for you and the right tenure of investment for you. When going in regular funds, definitely that means you're going through a distributor who will take care that you do well for your reaching your financial goals. Now, people prefer either or or other option based on their own needs. So there is nothing that says one is better than the other, but it depends on your own needs and how you are investing. I see a nice comment here on the chat that a financial manager has too much of knowledge. Don't you think you are contradicting the statement that too much is not appropriate? Well, you are getting this presentation from a financial manager who has experience of 21 years. And he is telling you that just knowledge is not important. Temperament is more important. Okay. If I know everything about how a knife works, okay, and all the metals and all the, like, how it cuts and everything, I will not become a good doctor, no matter if I can write a whole book on how knives are, right? So it is more important that you have the right temperament. Temperament is your wisdom in equity markets. And I'm saying this after 21 years of experience in this.
Yes, so there is some weightage in that response. So I think people will agree on long-term investments and taking advice from the right financial manager. Yes.
Is that all then?
Hello, am I audible?
Yes.
Shall we proceed to the next session?
Okay, I guess
Can I speak a question? Can I tell the question to Mr. Nitin?
Yeah.
I'm Dr. Ramesh Shah. Because my video is not visible, I would like to ask, most of the fund managers, they usually talk what is happening in the past, the past experience they have, the various nifty levels of the past and everything. I request him that which sectors are of your choice that invest for next 5 years.
Okay. So about sectors, I would say that while from here on, I believe that the capex side of the economy is likely to do extremely well. In the last, say, 9 years, from 2012 to now, we have seen the investment climate in the country, I'm talking about investment in projects, to be actually quite low. Sentiment was low. From here on, I believe that will pick up. So I believe government, which is already increasing investment on the infrastructure side, I think that will accelerate going forward. So government investment in infrastructure is your project side or the capex side of the economy. Second, private investment will pick up in manufacturing, not only for import substitution or Indian market, but also for exports. The world is looking at India as a good sourcing partner. People are looking at China plus one strategy. The third part is household spending or household capex in the real estate sector. After a long time, we are seeing improvement in the real estate market. This market was affected by everything in the last 5 years, whether it was demonetization, GST, RERA implementation, bank cleanup that happened, and the pandemic that came in last year. From here on, I see better prospects for real estate. So if you combine infrastructure, manufacturing, exports, and real estate, there are so many subsectors and industries that benefit. And also there are a lot of companies in this area that will do well. Obviously, the selection of companies will depend on how good the business is, how good the management is, and what valuation you are paying for them. But I believe the capex side of the economy will see accelerated growth in the next 5 years.
Thank you so much, sir.
Hi, Nimesh, Jignesh here.
Hi.
Am I audible?
Yes, please.
Yeah. How are you safeguarding against the systematic risk given the sharp rise in valuations?
So sharp rise in valuations doesn't mean that the market will fall.
Okay.
Sharp fall in valuations doesn't mean the market will rise, right? Okay. Valuations have been a bad indicator for timing the market. However, what one does is move away from areas where the crowd has created excess in terms of valuation and move to areas which are getting ignored by the market. So that's why in behavioral finance, there is an element, or one part of it is to understand where the crowd has overreacted and underreacted and take advantage of that by being a contrarian investor. You would have heard investors saying, be greedy when others are fearful and be fearful when others are greedy. That's the philosophy to follow. There are areas in the market, especially say in some of the consumer companies, where valuations are extremely high. So one should book profits from that side and move to, as I mentioned, I see as a capex side of the economy where the growth is underappreciated or valuations deserve a re-rating upward. Those are the areas to invest in.
Thank you.
Thanks, Nimesh. Over to the committee, for like the, thanking and taking on the next session.
Thank you, Nimesh sir. This is Dr. Rajiv Agrawal. Please accept our digital certificate as a token of appreciation for a very excellent talk which you have delivered.
Thank you very much. It was a pleasure to be here. Thank you.
I hand over the mic to the next moderator, MOC. Thank you.
Thank you, Dr. Agrawal. First of all, let me take this up. Am I audible?
Yes.
Yes, you're audible. Yes, you're audible.
Yeah. First of all, let me take this opportunity on this auspicious day as a proud Indian to wish every Indian a very, very happy Independence Day. And this wonderful program that AMC along with Finovate is holding, let us hope it guides us towards our financial freedoms. With this, I would like to invite the next eminent speaker, who's an insurance veteran for over 18 years of experience in the insurance industry. He has completed his post-graduation insurance management from SIBM Pune. He had a 9-year stint with ICICI Prudential Life before joining HDFC Life in the corporate agency channel. He was an integral part of e-commerce and digital marketing team at HDFC Life, setting up the managing the aggregator channel. He currently heads the digital alliances channel with HDFC Life. So I welcome Mr. Subrata Bishwas for demystifying life insurance for all of us. Welcome, Mr. Subrata Bishwas.
Yeah, hi. Good morning. Good morning to everyone. And it gives me immense pleasure to connect with all from the medical fraternity today. And as a token of gratitude, I just want to convey that this has been a very, very tough couple of years for all of us. And the way the medical fraternity has stood by, and they actually turned out to be the real warriors for the humankind. So congratulations to all of you for that. And thank you again from the bottom of our heart to the medical fraternity. Yeah, it is really a big challenge to take it up from where Nimesh left. But what I can tell you is that Nimesh made my life really, really simple. Because whatever he spoke about, I will just have an extension to that particular conversation only. And he spoke about what exactly is the behavior linked to investment, what exactly is the long-term way of investment, and what exactly is the benefits when you actually go with somebody who is knowing the depths of the market, who knows the various ways in which the investment opportunities arises, and they go ahead and guide you along with. with the right set of goals and values. So I'll just take this particular conversation forward to what Nimesh has been speaking about. And why I'm going to be talking about a little bit on the demystifying life insurance is because of the fact that in this pandemic, apart from the medical fraternity, I think the life insurance industry is another industry which has really stood up to the test of time. The way we have gone ahead and supported people, not only when they actually were hospitalized with the COVID situation, but also with the claims that has got arisen. I think in the right sense, the insurance industry, along with the medical fraternity, has been the cornerstone of help and support to the whole of the humankind. So just to take things forward from here, why it is important to demystify the life insurance is because of the fact that people have had lot of biases against the life insurance businesses, and that is why we thought that we would just take this opportunity to let everybody know that how the life insurance landscape have been over the years. And it's an industry which has been in existence from the 1870s. So it actually got started with a very small concept when the ships used to be going for trades, and people used to come over and used to say that, okay, my ship is going for a trade, and if I lose that particular ship, I lose a lot of money. But if my ship reaches the shore, I make money. So are there people who want to take this risk along with me of the ship reaching its shore? And that is where the concept of insurance came into being. And from there, the general insurance then transformed into life insurance. In India, the life insurance business primarily was a nationalized thing, and the birth of Life Insurance Corporation happened in the year 1956. In the year 2000, the government actually went ahead, created IRDAI, and we just went around and opening up the whole of the industry, which is to the private sector. And thereafter, we realized that there are now around 24 insurance companies who are operational in India. Now, if this industry is being looked at, if you look at very closely, the way this particular industry has performed, over the years, the CAGR of this industry have been in excess of 19%. Not many companies or the industries have grown to that particular extent. So this particular sector has been a very sound sector in terms of the way the growth has been. LIC dominates the market share here, but the private companies are starting to make their mark. And if you look at it, whether it is SBI Life, ICICI Pru, HDFC Life, all of them have started making a comprehensive growth story, now realizing for the investors. So out of this, if you look at ICICI Pru, HDFC are already there in the market. HDFC Life is in fact a Nifty 50 company today. So there is a lot of prudence when it comes to financial evaluation of the way the insurance companies are working today. Yeah, we can move on to the next one, please. Now, what exactly is the role of IRDAI and why I'm talking about the role of IRDAI over here? Primarily because of the fact, and what Nimesh was speaking about, is that people have been investing in the stocks for long. And the role of IRDAI in the insurance business is primarily a role which a regulator does in any other industry, whether it is an RBI, whether it's an SEBI. So similarly, IRDAI regulates the complete insurance business today. And if you look at it, the kind of regulation today which exists for the insurance companies is pretty comprehensive in nature. It comes not only from evaluating the way the finances of the companies run, it also comes in from RDI as a way in which the products needs to be structured, the costing of those products. And that is why you will see that over the last 20 years, the way the insurance products have evolved is quite different from the way the products were when in year 2000 when the insurance business was opened up. How exactly IRDAI regulates it? So IRDAI regulates this with some of the financial aspects of it, like a solvency ratio. Now, why solvency ratio is important? Now, the solvency ratio is important because it clearly indicates that up to what extent an insurance company should be capitalized, up to what extent there should be asset liability match for an insurance company. So it clearly articulates that the asset should be around 150% of the liabilities that an insurance company takes. Why do they do that? Why does the regulation so clear on these aspects? It's because of the fact that the insurance companies generally go ahead and get all their monies through retail businesses. they go ahead and take monies from small investors. So at no point in time, the government or the regulator wants any of the insurance companies to wind up. And primarily because of the fact that insurance companies today have been running in for more than 100 years. Some of the insurance companies abroad, if you look at it, they have been in existence for more than 100, 120, 150 years. And that is precisely where you will see a long-term story playing up for the insurance companies. So primarily to safeguard the right of the policyholders, the insurance companies are regulated by the regulator. And there are turnaround times for everything which is defined by the regulator today. It defines the turnaround time for a policy servicing, complaints, grievances. To that extent, this particular industry is regulated. Yeah, we can move on, please. Yes. So, at any point in time, if the insurance company has defaulted on any aspect of its business, the customer can always reach out to the IRDAI or the ombudsman in this particular business, and that is how the regulator maintains and manages the whole of the insurance business in India today. Yeah, next please. Yes, so these are some of the interesting things I want to take on over here, and just creating this particular slide, we just wanted to communicate to every investor and every customer of ours that how exactly the insurance business today mitigates the various risk which arises from the kind of money that an insurance company holds today of a common man. Yeah. So if you look at the valuation of insurance companies today, and HDFC Life today on the Nifty is valued at more than 1,70,000 crores. So it's a huge valuation that the company has today. So because of the kind of valuation they have, there are a lot of people who are actually the investors. So the company today, if you look at LIC plus and ICICI Prudential and HDFC Life and SBI Life, the kind of monies that they are holding of the general investor, it is very, very prudent that everybody who comes in and invests for a long term, they actually know how their monies are getting managed. First is the credit risk. The credit risk is primarily the loss resulting from a borrower's failure to repay the debt. Okay, to meet a contractual obligation. That means that if I have taken money from an investor, it is my obligation to make sure that I return that money. Now, what happens is that, and like any other financial organization, the insurance companies also take in money, invest somewhere, and the returns generated out of it is then forwarded or given back to the customers. Now, how this credit risk is mitigated? That means if the company has taken money and then forwarded this money or given this money as a loan to somebody, and that money does not come back, is primarily the credit risk. The first thing is that there is no direct exposure to retail lending here. That means insurance companies are not allowed to do retail lending. And when it comes to corporate exposure, that also is clearly defined by the regulator. So the credit risk is managed and evaluated and regulated by the regulator to a large extent. Second thing is the interest rate risk. So the interest rate risk is again something that if the investors have put in money, and if the insurance company going ahead has to generate a revenue out of it and then provide a part of that revenue back to that investor, so they should have some ways in which they will mitigate any interest rate risk that may arise in future. Now, how does that interest rate risk gets mitigated? Obviously through diversification. And if you look at it, the kind of bond market today that are there, so there are corporate bonds which are available for 40 years also. Even the government securities are available for 40 years. So insurance companies primarily look at long-term investment. Even in the kind of products that I will be speaking about going forward, the primary responsibility of an insurance company, the philosophy is to look at safety, security, and returns. That means the money that the insurance company gets in, they are driven by the philosophy that the money should be safe, it should be secured, and then the return should be generated. So what Nimesh was primarily speaking about, a long-term investment, a diversified investment, looking at the valuations, but at the same time, taking care that we are not exactly getting driven by only information edge or analytical edge, but it's primarily the behavioral edge which makes money for an investor. Now, the insurance company, primarily what it does is that takes care of the behavioral edge by keeping the money invested for a long term. And that is why the mitigation in terms of credit risk and interest rate risk comes in. The third is mortality risk. And nobody better actually understand the mortality risk than the life insurance business today, and especially in the last 2.5 years. Now, if you look at it, though the official figures may be saying that 4.5 lakh people died in India of COVID, but the kind of experiences that we as a life insurance industry have been seeing, we believe that the rates must be, or the numbers must be pretty higher than what has been reported. And you being in the medical fraternity, you know for yourself those kind of numbers that you have been handling on a daily basis. Now, what we have seen is that in spite of this kind of spike, which happens maybe once in 50 years, the insurance companies have been able to navigate really, really well. They have been able to stand by the customers. They have been able to give out the claims which have come in. They have been able to support the customers in terms of whether medical insurance or life insurance is concerned. In fact, the claims have been to an extent of even 3x for the insurance companies, 3 to 5x. Various insurance companies have experienced claim to an extent of 3 to 5x of the mortality risk that they would have accounted for in this particular year. But the way the mortality piece has been accounted for, and over the years, they have been able to sustain it and have been able to still produce strong result in this particular quarter. So you would have seen, some of you must be investing in some of this company, you would have seen how ICICI Pru has grown in terms of the stock valuation from 350 maybe a year and a half back to a 670 today, or an HDFC Life from a 320 or even 290 odd in 2017 when it got launched to whatever 680 odd at this point in time. So the market is also responding, and these are publicly traded companies. So everybody in the market knows what exactly these are companies are doing, how their balance sheet looks, and they are scrutinized by the best of the financial consultants. Yeah. Okay. Now, coming to the types of insurance plans, why it is important to know of these, because a lot of people feel that the life insurance business is only about protection. Obviously, protection is a primary thing, and it should form a very, very important part of everybody's financial planning. But apart from the protection needs, there are also needs for a long-term investment, goal-based investment, which Nimesh spoke about. The goal-based investment comes in primarily from the fact that insurance companies are long-term wealth builders. And obviously, the insurance companies have plans which are debt-based, which are endowment plans, or a unit-linked plan, which is again a sort of a mutual fund, but on a long-term basis, this plan works. Now, when it comes to endowment plans by the nature of itself, I'll just take a couple of minutes here because I believe that this is an important aspect of everybody's financial planning. An endowment plan, primarily what it does, it takes money from a small investor and invests money according to how the government has stipulated in very, very safe investments. An endowment plan primarily has two components. One is a participating plan, and the second is a non-participating plan. A non-participating plan is a very, very simple one. It says that, okay, I have taken X amount of money from an investor, and over a period of time, I will return an Y amount of money, which is guaranteed by an insurance company to the investor. So that's a very, very simple one. And if you look at it, the participating plans have really, really been big performers for insurance companies, participating as well as non-participating. So a non-participating plan actually gives you a defined growth rate and a defined IRR. That means the customer does not participate in the profit of the company, but invests money just for a defined growth. That means if I put in X and if I've been told I will be getting 15% or a 10% or a 6% rate at the end of an X amount of years, I will definitely get that. So a non-participating plan is that, which is a defined rate. And if you look at it, some of the IRRs of non-participating plan from today, from the top insurers, is to an extent of 6.1, 6.2% also. And these are tax-free returns that I'm talking about. Now, what are participating plans? In endowment plan, the second plan is a participating plan. That means the customer invests a certain amount of money, participates in the growth of the fund, and then 90% of the growth is plowed back and given back to the investors. So again, here, the insurance companies not only invest in the debt fund, but also a part of it gets invested in the equity fund defined by the IRDA guidelines. And they actually generate a better return than some of the non-participating plans that we have, because a non-participating plan obviously have a spread, whereas a participating plan will have a lesser spread as compared to a non-participating plan. Similarly, the third one is a unit-linked insurance plan. I was listening to Nimesh, and then there were a lot of follow-up questions which came in, and where people were asking about mutual funds, diversified funds. And I can tell you the unit-linked insurance plan today of some of the top insurance companies are very, very strong competitors to the mutual funds. These plans, unit-linked plans, have an opportunity to switch between debt, equity, or balanced funds. They have an opportunity to invest in a diversified equity, or have opportunity to invest in a diversified multi-cap fund. All of that opportunities exist in ULIP plans today. So whenever a person is actually looking at his complete portfolio and a goal-based financial planning through a financial planner is getting done, at that point in time, all the asset classes should be looked at. Now, how in the last conversation we were saying that even the best of the Nobel Prize winners, when it comes to their own investing, they were not only investing in equities, they were also investing a great deal of money in debt. So it was a 50-50 allocation. So that is precisely what a investor should be doing. He should be not only looking at an only equity investment, he should definitely be looking at an equity, a debt, a long-term investment. And that is how you build money over the period of time. And obviously through somebody who can actually guide and hold hands through this journey. Yeah. Okay, so how does an insurance company invest in equities? So the insurance companies are allowed to only invest in such kind of equities where the companies would have shown a dividend of last 2 years, they would have given dividends, and the minimum dividend declared will be 10%. So you can easily see that all the information that an investor needs in order to go ahead and play the equity market, there is somebody who is already doing it at the back end when it comes to insurance companies. And you don't only need to trust that insurance company, but you can trust it more because there is a regulator who is closely monitoring these investments. Unlike some other places where the fund managers up to themselves decide what exactly and how exactly the investment will happen, here there is a regulator which really clearly dictate terms in terms of what kind of equities you can choose, what kind of investments you can do, what can be the duration, and all of that is clearly specified by the regulator. Now, when it comes to investment in the traditional plan, where I spoke about the participating and non-participating one, minimum 50% should go into government securities, 15% into infrastructure and housing. Nimesh was speaking about how the housing sector can grow going forward. And obviously the participating plan, when they invest in this particular sector, definitely have the potential of a higher growth. So what I'm saying over here is that there is a clear-cut regulation which is there. The organizations have to follow those regulations when it comes to investment. And safety, security, and returns is the philosophy how an insurance company invests this amount. Yeah. So what should, yeah, we can move ahead. Yeah, choosing the right insurance. So what exactly are the various factors that somebody should be taking into consideration when they're actually choosing the insurance company? So first thing that you should be looking at is obviously the solvency ratios. And I can assure you that the way the guidelines are today of the regulator, the top 8-10 companies are definitely very, very strong. And the regulator on a quarterly basis evaluates, looks at all the financial ratios of all these companies. So you can rest assured about the fact that it's not only about individual insurance companies, it's also about the industry and the regulation which defines the strength of these organizations. Second is the claim settlement ratio. Obviously, if I am putting in money and if I am taking an insurance cover from an insurance company, I won't be there if I have taken a protection plan when the money actually comes to my family. It should be so transparent. It should be so strong that the money really comes to my family when they need it. And that precisely what is defined by the claim settlement ratio. The third is obviously the claim settlement turnaround times, that how much documentation is needed, by when this particular claim will be settled. If I'm going to take a maturity, how soon a maturity amount is going to come to me? If I'm putting in a ULIP plan, how soon can I get my money back? How soon can I get through a digital medium this money taken out from my account? So all of these needs to be looked at. So if my policy matures, can I go on a policy on the platform of an insurance company and request for a withdrawal from there? So all of that needs to be looked at. How strong is the digital setup of an insurance company? All this needs to be looked at when you choose a right company. And obviously the incurred claims and the business volume managed. As I said, the big ones, whether it's an ICICI, whether it's an SBI, whether it's an HDFC, Max, Tata, these are all big organizations. So you can always keep them into your consideration set when you are actually evaluating your opportunities when it comes to financial planning. Yeah. When it comes to unit link plan, obviously these are some of the things. What are the various charges involved? What is the risk appetite? What is the fund performance? What are the various fund switch options? And all of these are available today in the new age ULIP plans. Definitely should be looking at it. Yeah. Yeah, so that's more or less what I wanted to speak about. So it's a financial tool which is there, which should be there as a part of your basket for investments. And I'm pretty sure that all of you would have given a lot of thoughts towards this particular thing. Some of you would be having insurance cover for yourself and your family members. But not only you should have a life insurance cover, you should also look at the various investment options available in a life insurance company to actually do a goal-based financial planning. Yeah, that's about it from my side. Thank you. Yeah, any questions, please?
Yes, thank you, Mr. Biswas, for your insight into insurances. So we all understood nowadays the importance of having a term insurance in our kitty, but there always is, debate as to how good an endowment or how good a ULIP would be to have in our portfolio. How does it compare to having other instruments? So, I mean, how do we compare it? Is it wise to go ahead with the endowment kind of an instrument, a ULIP, or I mean, how
basically the question which comes is, should you mix insurance and investments? This is
Okay, great.
a debate which is going on since a decade.
Right, right, Neil. I think that's a very, very pertinent point that whether you should do actually mix an investment and an insurance. Now, when it comes to this particular deliberation, what I can tell you very clearly is that every individual should definitely have a term plan. There is no two ways about it. Now, why should you look at an endowment plan? Why should you look at a participating plan? Now, or a non-participating plan? It's because of the fact that these are the things, these are the plans which definitely going to give you a return which is a goal-based kind of return. And these plans, by the construct of themselves, actually propels the customer to stay invested for a long term. Because what happens is that if I'm investing in an open-ended mutual fund today, I invest in that particular fund, and as soon as a pressure on a financial side comes on me, I have the attitude or tendency to go and liquidate that particular fund. And I believe that the money coming out of it, I will put in some particular way where I will be able to generate maybe a better return, or I will satisfy a need of mine. So the goal-based approach that an investor starts off with at the initial stage actually gets compromised somewhere down the line, maybe 5 years, 7 years hence. But an endowment or a participating or a non-participating plan, by the construct of itself, will propel the customers to stay invested on a long term and generate revenue and returns based on the goals that he has assumed at the start of the investment. So that's precisely why we should stay invested.
What I would also like to add is that we are talking to medical professionals who have the risk of medico-legal at all point of time. So while a term insurance is must for the protection needs or to replace your income, you have professional indemnity to handle your medico-legal thing. But at times the professional indemnity is not enough, and it is an expense because the premium which you pay goes away. Okay, so generally there is a concept called Married Women's Property Act Trust, the MWPA Trust, where if you are saving 100 rupees in a year, maybe just 5% of that, 5 rupees, if you start putting in an MWPA Trust, here the objective is not return. The objective is that in case if in future there is a medico-legal issue, or there is like an income tax matter or any kind of an litigation, then I don't want to expose my entire wealth to that litigation. Okay, so while a professional indemnity will help me to a certain extent if it's medico-legal, but the professional indemnity money can come later. What if I need money to fight a case, or I need certain liquidity when I'm going through a bad time? Like I have just come across one case where where the bank accounts of the doctor was freezed, and immediately liquidity was an issue. Luckily that person had a brother who was a big businessman, and there was some liquid money available. So at times a return is not always the only thing which you look in your financial portfolio. You also look at ring fencing certain amount of money. So we feel that the other reason why somebody should come to a life insurance company, apart from term insurance and apart from I'll say returns, like returns is not what great returns, no life insurance company can give you great returns, but it can give you a ring fence in an MWPA trust where a certain portion of your money can get saved, and it only belongs to your wife and children in case in future if there are like medical legal cases or litigation or any kind of income tax issues. So PPF is one thing which is a deemed trust. Everybody on this earth, themselves and their family members, should all have PPF. It is a deemed trust. The second deemed trust in India is MWPA, which can be only taken with an insurance policy. And so this is what I would like to add to what you said, that it is long term. And the second thing is that people invest in debt. Like Nimesh just said, that you should invest in debt and you should invest in equity. Okay, so when you invest in debt, say if you are investing in debt mutual funds, like you said, the regulation in mutual fund is not that strict. The fund manager can take a call, right? So there can be credit risk, which we saw in the Franklin Templeton debt funds, where there was a huge credit risk and the money of the debt fund holders did not come back. So on the debt portion of your investment, you don't want to take any risk, because you are not doing debt to earn return. You are doing debt to protect your capital and earn a little more than the bank return and tax free return. So that is where you can look at life insurance as an option, where historically no life insurance company has ever defaulted. Okay, it gets merged with another insurance company. In fact, I will say bank also, if you're doing fixed deposit in a bank, there is a certain risk with a bank defaulting. But with a life insurance company, given the regulation, like you said, the solvency ratio, with all that, there is a certain amount of security. The way a life insurance company handles your money, 50% is in government bonds and securities. The balance is in AAA and AA rated papers. So they defaulting on a debt fund has never happened historically. So that component which you want to put in debt, where you don't want to take any risk, it's okay if you earn a little less return, but at least you are sure that I am not taking a risk on this debt component. That is where I feel that though it's a sad thing that you should not mix insurance and investment, which is right. For your term insurance, you should have a pure cover. But if you have some investments in debt, or you have a special need, which is an MWPA trust, okay, that is where you should probably study further. I think you can ask, sorry to interrupt, but I think this was a very important question which has been coming in. As a financial planner, I have looked at situations where things have gone really bad with medical legal or income tax or other matters, and I feel people should be aware that there are many other options which can help you ring fence in bad times.
Yeah, so Nehal, just an extension of whatever you were speaking about. I believe that apart from MWPA, there is a keyman insurance, especially people who have their small organizations, because some of you must be having a chain of or your hospitals, or you will have created a private limited company or a partnership firm. All of these companies, or even for a proprietary company, you can have a keyman insurance, you can have a partnership insurance, all of that, or for that matter, today, if you look at it, we can actually secure employees also through an insurance plan. That means for our own employees, we can give them a reason for staying with us if we actually go ahead and secure them through an insurance plan. And all that money that we pay from the company's account, that can get adjusted as an expense in our books of account, reducing the total tax liability on us. So it's a fantastic tax management tool. So if you look at it, it's a fantastic tax management tool when it comes to keyman insurance. It's a good tool when it comes to MWPA. So these are different opportunities which only an insurance policy can provide. Yeah.
Yeah, Mr. Biswas, this is Jignesh.
Yeah.
Yeah. My question is, how is endowment plans comparable to bank FDs?
Okay, so Jignesh, if you look at it today also, I will not go back in history. I will just pick it up from whatever is available today. Okay. Now, in back of days, what you get is a 5.5%, 6% kind of a return today. Okay, and all of this is taxable. The kind of customer base or the kind of people we interact with, all of them must be in the 20%, 30%, 35% kind of a tax bracket. Okay. Now, if you are in a 34.44% kind of a tax bracket, it actually doesn't make sense to put in money into an FD. But if you look at it today, even on the endowment side of it, the non-par products that I spoke about, today is a very strong opportunity which has come in the last couple of years, and it is still existing with the interest rates down. But the insurance companies are today giving non-participating policies where the interest rates are guaranteed at 6%, 6.1% tax-free. Some of the portions, if you can just pick it up in some of the insurance companies, you can actually get a 6.3 to 6.4% tax-free return on a guaranteed tax-free return for a duration up to 35 years. So you can well assume that if I look at it today with how the interest rates have been going forward, also if the interest rates are going to be coming down, and today if you can lock your money for your future investments also for a 35 years at a 6.1% tax-free return, I think there can nothing be which is better than this. So you don't have to worry about the fluctuations. You don't have to worry about the volatility. It's defined tax-free money in your kitty. Yeah.
So when we are looking for long-term goal, goal planning, where we decide on certain percentage out of 100, diversifying into that category, this is a good option according to you, right?
Yes, it surely is a good option.
Right. So as I understand, Mr. Biswas, insurance investment, when mixing insurance and investment together, it can be used as a tool for many other reasons apart from purely just insurance. Like, for example, in case of MWPA or retention of employees, giving back to your employees in certain way. So this is one of the tool which can be used as a key man insurance also.
Right.
So I think that would be all. There are no more questions come forward. So I think I would thank you on behalf of all the attendees and participants for a wonderful, I would say awareness into life insurance, not as only term and endowment as an investment, but other tools as well. So I would, pass on to Sushmita ma'am and the AMC team to take it forward from here. Thank you.
Thank you.
Thank you, Mr. Biswas, for this wonderful talk and insights into life insurance. Please accept this digital certificate as a token of appreciation from AMC.
Thank you so much.
We would like to move on to the next talk now. We have already heard her a lot during this program and her views. She is the co-founder and director of Finovate, which is a SEBI-registered investment advisory firm. She has been shortlisted amongst the 40 women entrepreneurs by Goldman Sachs and NSR Cell IIM Bangalore for the 10,000 Women Entrepreneurs Program. She's a postgraduate in management from Mumbai University and MDB from IIM Indore. She has a very rich experience of 18 years across the financial services industry. She has conducted more than 500 educative workshops and webinars as a part of financial literacy initiative over the last decade. And she also has trained over 25,000 people to successfully manage and grow their finances. I would like to welcome Ms. Nehal Mota, the director of Finovate, who has been associated with AMC for quite a long time, for a financial life planning. Thank you, Mrs. Mota, and welcome.
Thank you so much. A happy Independence Day to everyone. And I would like to thank AMC.
Awaz.
Okay. Is it better now?
Please.
Yeah. Okay. So I would like to thank AMC for giving us this platform to spread financial literacy. Over the 10 years, I have really seen AMC evolve with a focus on unbiased learning for all its members. I think the speakers have covered a lot of important points, and the panel, like the eminent speakers on the panel, they are veterans. They will talk with their experience. And I have looked up to Dr. Nitin Bagali, to Dr. Ramakant Deshpande, and Dr. Ramesh Shah, each one of them expert in their own field, not only in medical, but also with investing and managing their finances. So I will not take a very long time and come in way of the panel discussion. I will very quickly just leave a thought of what financial life planning is and how each and every doctor should be looking at their finances. So I will say that there are 6 pillars to personal finance. Understanding your cash flows. So over the last decade, when we were talking to medical professionals, they had no clue exactly what is their income, what is their income from the profession, and how much is take home out of that. So no distinction between business finance and personal finance. So I think the first step to personal finance is understanding cash flows, risk management, which we tried to touch upon in the previous section, loan management, goals planning or wealth creation, which was the objective of today's discussion, taxation and succession planning. So basically our financial life, or I will say, the financial life planning is based on these 6 pillars. A lot of time people come and ask me about returns. So I said returns is only one part of your financial life. What if you're earning a great return in your equity portfolio, but you're investing too little? Okay, would it make sense? What if you are investing and making good return in equity, but you have not looked at your risk management? Then I think nothing else will be important. What if you are, investing a lot of money, but not paying off your debts, which is at a high interest rate? So even if you are, earning a 9% or a 12% will not make sense if you have loans which are at 14 and 16%. So I say that financial life planning is a balance or a holistic view between these 6 pillars of cash flow, risk management, loans, goal planning or wealth creation, taxation, and succession planning. And I will just share a framework as to how doctors can go about incorporating all these 6 things in your practical life. So moving on, this is a framework which we have created for all AMC doctors, and this is what we want them to follow. There is a foundation which you need to set in managing your personal life. So when people come to us or doctors come to us, we diagnose that there is a low net worth of financial assets, because generally over the last 10 years we've seen people heavily invested in real estate, probably 90-95% of their wealth, fixed deposits, gold. But when we look at the equity, it is not even 5%. In fact, I will say that whatever people today on this discussion, just go and do an asset allocation, and I'm very sure out of the 4 buckets, you will yourself know which is the asset class where you're very heavily invested in. So I will say that people come, there is a low net worth in financial assets. They have debt, they have a lot of loans. When I look at the risk management is not done. They have 1 crore term insurance and they think, okay, that's enough of life insurance. But why 1 crore? Why not 5 crores? Can you just put your hand over your heart and say that I can just sleep peacefully? I am not worried about my family's financial future because I have taken care of all these 6 aspects, and I have taken care of risk basically. And probably 8 out of 10 people needed help or needed to look at their risk very differently. Okay, so I will say that we start with laying a foundation in your personal finance, which is we help you to understand your cash flows, what income, what expenses, what percentage of money are you saving, and are you earning, then spending, and then what is left you're saving, or can we actually earn, set aside a certain amount of money, calculating the future value of our goals, and then look at spending. And basically, how will that spending be? 50% needs, 30% wants, and 20% compulsory savings. So, the step or the foundation which you need to set is get your cash flows right, then do an audit of your current investments. How many people in your family are dependent on you? Do you have insurance for the dependents? What if something happens? How do you want your wealth to be divided between the different family members? Do you have a PPF? Do all the family members have a PPF? If you are in the highest tax bracket, and probably an HUF can help you, save additional. So do an audit, which means you analyze where do you stand today and what do you have in your investments. Please write it down at one place. That is a step 2 to lay your foundation. The step 3 is now creating a financial plan. Okay, and what do we mean by creating a financial plan? Like, for example, if I today want to live without going to work, I need 1 lakh rupees a month. And I think I can live comfortably. I have my own house. I don't have liabilities. Then this is enough for me to have a very decent lifestyle. But today I'm 40. when I turn 60, will today's 1 lakh be enough? Today's 1 lakh at the age of 60 will probably be 3 lakhs or 4 lakhs with a nominal inflation of 6%. Okay, so to earn that 3 or 4 lakhs when I turn 60, I probably need to save an X amount of money today. So I do a backward calculation and decide on my saving goals for a particular, event, which could be retirement, which could be kids' higher education. And I factor in from the today's expenses, I add inflation and I get a future value. And for that future value, how much I'm supposed to save now. So that is a financial plan. And each one of you shouldn't have these numbers in your mind. You should have a written financial plan. What this does, this takes you from a confusion to clarity about where do you stand in your financial life today. So this is your objective of laying a foundation. Moving on, the next thing in financial life planning is before you make your investments, you need to do risk mitigation. Okay, so I will say that 3 Ds, the D for death, the D for diseases, and the D for disability. At all points of time, your family needs to be planned for the 3 Ds. So the next step in the execution of your financial plan is basically doing the risk management. And luckily at Financial OPD, at Finovate, we do a complete risk analysis of who the family members are, what is the situation, who are the dependents, and they make you plan in such a way that God forbid you're planned for any eventualities at all point of time. That is how you yourself can do your financial planning by first step, which is risk mitigation. Now, after that, I said that you have created a financial plan for you, which says that you need to save, say, 1 lakh rupees a month, 50,000 a month. You get that, and it's not a random number. It is linked to your future financial goals. So now that random number, where do you invest? Okay, so the next step in your financial life planning is asset allocation. Like there are broadly 4 assets in which we Indians invest. So we invest in real estate, we invest in gold, silver, bullions, we invest in equity, and we invest in debt. So now here you create a complete asset allocation as to this saving 50,000 or 1 lakh. How do you want to balance or apportion between the 4 major asset classes? And this you should sit with your financial planner and write down that this is what my asset allocation is for the next 3 years, 5 years, 8 years, 10 years. That's like a long-term view on your asset allocation. And here I will say what Nimesh said and what the previous speaker said.
Your voice is again very low.
Okay, hello, is it better now?
Your voice, you're not audible.
Okay, just 1 minute, 1 minute. I will just. Is it better now?
Not really.
Okay, just 1 minute. Is it better now?
It's okay, but not really very good.
Okay, fine. I will try and increase the pitch a little because I am talking from the PC. I don't know why the voice is issue. 1 minute. Okay, so I'll say that the next step is asset allocation, getting in that amount of saving. Where will you invest? How much in equity, how much in debt? And here, my advice to all doctors is that you should create your investment policy statement, which guides your decisions in making investments. It should not be, okay, tomorrow market is going to fall this much, so I will, move more to equity. Or if tomorrow markets are going to rise, I will move more to debt. So you are actually reacting to the market situation. And like Nimesh said, that nobody can predict what's going to happen in future properly. So the best way is step out and create an investment policy statement where it is defined that if market falls by 15%, this is my tactical allocation. When markets rise, this is how the asset allocation will move. This is my core portfolio, which I will not sell, which I will not exit mutual funds or exit shares depending on market. And there is a satellite portfolio, which I am using to create an alpha. Pranav, if you can just share how an investment policy statement should look for the doctors, and it'll help them, towards the end, once I finish the framework, if we can just share the document. Yeah, so this is how the screen is not proper. It's coming blur and not straight. So this is how a doctor should create an investment policy statement. We'll share a copy of that also for everyone's benefit. Once you have the asset allocation, now you start investing. So people come and say, okay, oh, tell me which is a good investment. I say investment comes much later in your financial life. First, get your foundation right. First, get your risk right. Then you fix your asset allocation and then actually get investing. And in investing, try to look at online options, direct plans, wherever you can save money in commissions, the better. And for doing or handling all these investments for you, you pay a fee to a certified financial planner or SEBI registered investment advisors, where they are not eating off your commissions, but they are actually taking a fee and genuinely and unbiasedly advising you. So that is where investing comes. Moving on, now we've got the execution stage, right, where we moved from being unplanned to being planned in our financial life. Okay, and then the next is, how do we get to freedom? How do we become passive investors and not track our portfolio on a day-to-day basis? I will say the next step is tracking. And what do we do in tracking? Just look at it that you are investing for long term, say 10 years. And if the historical market average is 14%, and if your portfolio is giving you close to 14, it is good. You don't need to change shares. You don't need to change mutual funds a lot often. And you should not have too many funds or too many stocks. Probably just 8-10 mutual funds are good enough. Just 15-20 companies are good enough, because only that as a person you can track. So the less is more in finance. Okay, and you should then track your portfolio probably on a quarterly basis, just against the benchmark, how your portfolio is doing. If for a few quarters your portfolio is underperforming the benchmark, should you go and sell it? No, not needed. You have to have a benchmark that I will judge my equity portfolio over 10 years or over 8 years. And there will be a certain tracking mechanisms which I will build. So that is how you go ahead and track your portfolio, then rebalance. So like I said, in the IPS, you have to clearly define that if market falls between 15 to 30%, I will invest more. Okay, and at that point of time, I will not get carried away by the crowd and start selling. Okay, because I have predefined when or what are the trigger points when I will rebalance. What is a trigger point when I will exit a company if I find the management is not doing good, or there is a change in the sector, or there are some major events, that is where I will sell or I will rebalance. And last but not the least, your financial life is completed and you create wealth when you let the power of compounding to work for you. And power of compounding is magical after 12, 14, 18, 20 years. Okay, first 8 or 10 years or 12 years, you don't get that effect of power of compounding, but there is an exponential effect after 14, 18, and 20 years. So this is a framework in which a doctor can go about handling his financial life. And this is a structured and a very systematic way to do it. So, without wasting too much time, I'll just share like how a financial plan looks like. And this is like the summary. Like I said, the income rule, 50% need, 30% wants, 20% saving. Your EMIs should not be more than 40% of your income. Emergency fund, have an emergency fund 6 to 12 times of your monthly income at all point of time. Have a term insurance 20 times of your annual income. Have a health insurance 2 times of your annual income. In investment, my mantra is SIP in stocks or mutual funds. Invest in dips. Whenever there is a dip, add more. And PPF is the best instrument which everybody should have in the debt category. Consider an HUF for additional tax saving. And like I said, in finance, less is more. Less stocks, less mutual funds, less investment options. The more you consolidate it, the better it is. So with this, I would just want to summarize. And if Pranav, you can share an investment policy statement, because this is something unique. I think when a doctor creates an investment policy statement for themselves, a lot of confusion about timing the market, when to invest, valuation, and all that gets solved. So we'll just show you a glimpse of how you should create your IPS, and your investing decisions should be guided by your investment policy statement, and also like a glimpse of the financial plan. I think this document is not opening properly. Just a straight, it's coming very blurred. And okay, no worries. We can just show it later on if we have time. So thank you so much to AMC for this wonderful platform. So this is how your IPS looks like. You are telling your financial advisor that I believe you will act in a fiduciary responsibility towards me. I would like my money to be handled as per the instructions given below. How much emergency fund, how much money you need in 3 years. So your financial advisor cannot take a risk on that investment. Then for your long term, what objectives you have, just scroll down. What percentage of your wealth should be in core portfolio? What percentage should be in satellite? Equity, debt, gold, real estate, what is the asset allocation you would like to have? tactically, when the market falls by this much, you would want your equity allocation to go up or go down. In your tactical portfolio or your satellite portfolio, you expect a higher return, but you're ready to take a higher risk. So everything about your investment is summarized and in a document which you can hand over to your financial advisor, and he is then guided to help you take decisions as per your IPS and not as per the ups and downs of the markets and various asset classes. Okay, so with this, thank you so much once again, everyone, for giving us this platform. We are skipping the Q&A, so I think we can just move on to the panel discussion.
So I would like to take this opportunity to thank you, Ms. Nehal Mota, for this wonderful talk on financial planning. And please accept this token of appreciation from AMC for your very well spoken talk.
Thank
I
you.
would now like to hand over to Dr. Ritesh Agarwal to take forward to the panel discussion. Of course, let me add it. It gives me immense pleasure that from our own community of surgical oncology, Dr. Ramakant Deshpande sir is there. So over to you, Ritesh, to take over for the panel.
Thank you, Dr. Prashant sir. It is a privilege for me to introduce Dr. Rajiv Agarwal. He is a Vice President of Association of Medical Consultants. He is also the Medical Director of K. Kasturi Medicare Private Limited and Kasturi Care of Senior Association. He is a Treasurer for IMA Maharashtra State, member of IMA Standing Committee for JDN, member of Rotary Club for Mira Road, past President of IMA Mira Bhayandar, and past President of Bhayandar Medical Association. He will be moderating the session on Arthik Manthan along with Dr. Vivek Dwivedi. Dr. Vivek Dwivedi sir is a practicing orthopedic surgeon. He is a Zonal Director of Association of Medical Consultants, and he's also like my big brother and mentor. So over to you, Rajiv sir and Vivek sir, for moderating the session of Arthik Manthan.
Thank you, Dr. Ritesh. Raju sir.
Thank you, sir. Sir, you just introduce the speakers, then we'll go to the questions.
Yeah. So we are having 4 panelists, Dr. Nitin Bhagali, Dr. Ramakant Deshpande, Dr. Ramesh Shah, and Ms. Nehal Mota. So Dr. Nitin Bhagali, he is past president from Pune, of Pune Orthopedic Society, executive committee member of Maharashtra Ortho Association for last 3 years, for 3 years, 2016 to 2019, ex-managing committee member of IMA Pune for 10 years, managing committee member of Hospital Board of India Pune chapter. He has been an active investor in equity market for more than 3 decades, learned art of investment on fundamental analysis, has delivered many talks on finance on various platforms of medicos across the state and the country. And with the sole aim of raising financial awareness amongst doctors, he has delivered nearly 60 talks on finance on various platforms of medicos so far. We welcome Dr. Nitin Bhagali, sir. Now, the next panelist is Dr. Ramakant Deshpande. He graduated MBBS from KMC Hubli in 1976, MS from Tata Memorial Center, and trained at MSKCCNY and Royal Marsden at London. Worked as consultant cancer surgeon at Bangalore at Kidwai Center 1982 to 1985 and Tata Hospital 1986 to 2002. Then at Asian Cancer Institute from 2002 till date as executive chairman. He has pioneered thoracoscopy at Kidwai Institute of Oncology 1982 to 1985 and Tata Memorial Hospital 1986 to 2002. First to perform thoracoscopic esophagectomy and lobectomy in 2000 in the country, use of tracheobronchial stents in 1987. He has pioneered several surgeries and procedures for upper esophageal, malignant and benign disorders, esophageal exclusion bypass for TO fistula, lung surgeries, surgeries of pharyngogastrectomy, gastrostomy for upper esophageal cancers, and several pioneering procedures. Over 65 publications in national, international journals and book chapters on carcinoma, esophagus, lung, mediastinal, and chest wall tumors in textbooks.
He is ex-president of Indian Society of Oncology and member of various professional associations. He is winner of several individual honors orations, including recipient of Padma Shri Award in 2014. We welcome Dr. Ramakant Deshpande. The third panelist is practicing eye surgeon since last 30 years in Mumbai, Dr. Ramesh C. Shah. He has been a speaker at multiple financial events on various platforms for doctors. We welcome Dr. Ramesh C. Shah. Our fourth panelist is Ms. Nehal Mota. Raju Agrawal, sir.
Yeah.
We welcome you, sir. And we welcome
Thank you,
Madam.
sir. We straight move on to the panelists. Since we are late. My first question is to Dr. Ramakant Deshpande. Doctors as an investor and entrepreneur, when we know he is busy in his day-to-day practice and whole day he is busy in his OPD, IPD and everything, in surgery. What is your take? How do we balance between being a doctor and an entrepreneur? Do you think we should have professionals to help us or hire a professional financial advisor? Dr. Deshpande.
Thank you, Rajiv. Very happy Independence Day to everybody. Yes, being a doctor, most of us are really very busy, particularly those people who are practicing outstation and on their own are product. We are here in Mumbai also. Institutions give a certain amount of cushionage to us. While doing this, I think today, most of the doctors are investors in one way or the other. They invest in shares, they invest in properties, somewhere or the other. Whether you realize that whether you're an investor or not, you are an investor. So you need to put in some amount of your money. As I think the whole discourses now, what we had since morning, it delineates very clearly the principle that you need to decide what you want out of your profession and out of your money. And the real time for independence really comes when money works for you rather than you working for money. Please understand that money has got its own language. So you need to learn that language as much as what you have learned in medicine itself. So you cannot make that as just a side kind of a interest where you actually neglect investing money. As far as starting your, when you are actually working only in your clinic, you are doing a profession. When you start something more than that, you are actually doing a business where all business principles will apply. And I think Mrs. Geeta has already told us very, very clearly what are the principles of management there. So do we really, if it's an individual practice, you have your secretary and she takes care of your patient management, your some amount of your finance, auditing, accounting, etc. Though you will be managing the finance yourself as an individual. When you make the setup a little bigger, when you start running your nursing home, then maybe one or two people will start helping you. But if you have a larger setup, it always makes sense to take help from professionals. And you have your chief operating officer and various other categories of managers, the heads of departments, etc. Because see, if you are going to be a top line person in your own line, then why do you want to become a second line or a third line administrator and try to run an institution? So you have a top line person there also. And the same thing goes with finance. When you are dealing with your money, ultimately money is like fruit. It's like you are running a dairy and your milk is coming. Now, how do you deploy that particular milk? Now, if you don't have your own deployment system, and which nobody really has, no doctor has a finance institution or a bank of his own. So best thing is to deploy it appropriately. And it is essential that we must always have professional advice there. We always tell our own patients, you want to lose weight, please use the help of a nutritionist. Don't do it yourself. Fasting doesn't really help, etc., etc. And what is more important is the finance. And when you are deploying your finances, it's best that you have financial advisors. I'm not saying that you give away the money and ask somebody else to manage that thing entirely. Please participate in the management. Be a part of it. But the operational management, many times the thought processes can actually be taken help from the professionals themselves. And that is how you can actually leverage the whole growth. And this is what I always felt. I started investing in 1986. That's almost about 35 years. And I have always used the help of people who are experienced in the line, taken their advice. Ultimately, what you are going to do, it entirely depends upon you. But
most of the times people who have a concrete kind of a plan, a thought out kind of a plan, don't have a jerky reaction, stable kind of a investment approach will always be of great help to you. And that is absolutely essential. Thank you.
Next question is to Dr. Nitin Bhagali, sir. That is, what is better for newcomers? What should newcomers to do? What should newcomers do to learn about their finance and investment, like direct equity or mutual fund, sir? Dr. Nitin Bhagali, sir.
Thank you very much for inviting me to be a part of this seminar. And I wish a very happy Independence Day to all of you. Well, a newcomer has to learn that he has to have patience handling his money. What I would advise a newcomer, start saving and start investing at a very early stage in your career. Whatever you earn, start saving at least 20% of your earnings and put them in good, solid investment assets and be patient. See, investment in equity or equity related instruments, even in real estate or gold, cannot be ripe suddenly. You have to have patience and you have to see the fruits of compounding. If you invest rupees 1,000 today and if you are getting an interest rate of say 12% a year, after 10 years, it's not going to be 2,200, it's going to be 3,300 because you are not withdrawing your interest from whatever you have invested. After 20 years, it's going to be 30,000. After say 30 years, it's going to be somewhere around 45,000. So you must know that once you start investing, don't be in a hurry to withdraw your investment. You have to be patient. You have to track them, okay, but you have to learn to be patient with the investment. That's number one. Number two, you must know that whatever you are investing should outpace inflation. See, there are two things which are going to take away your returns from the investment. One is taxation and two is inflation. So when we talk about inflation, it's not just food and beverages inflation. We belong to an elite class of society. We want to educate our children in a nice possible way. We want to give best possible medical help to our dependents. So also we want to have elite club memberships and have to have international vacations. So all these factors put together is called lifestyle inflation. So if you average lifestyle inflation, which is around 15 to 16% a year with government figures of CPI or so wholesale price index, it's going to be around 12%. So any investment which you make should outpace inflation and your pre-tax and post-tax return, there should be minimum gap. So you invest in such an asset class where your tax outgo will be minimum. So you have to learn it and you have to master it. And then only you will really bear fruits from your investment. Now, as far as choosing the asset class is concerned, if you do not know the intricacies of stock market and individual shares, I would strongly advise you to go through an indirect route. See, all said and done, equity and equity related assets gives you the best possible returns which beat inflation, number one. Number two, if you consider the pre-tax and post-tax returns from any asset class, it's again the equity which gives you the best advantage of minimum tax outgo and maximum gains for an investor. So once you come to know that equity is the best asset class despite its up and down intermittently, it is going to outpace inflation and it's going to give you the best returns post-tax. And if you do not know yourself the intricacies of the stock market, because it's complex in the beginning, people don't understand it. Why not go through an indirect route of mutual fund where an expert will invest your money into multiple stocks which otherwise as an individual retail investor you may not be able to afford. It will give you asset diversification as far as sectors are concerned, geographies are concerned. So I would suggest start early, save regularly, invest regularly, track your portfolio and study the tax outgo and be very prudent. Start investing at an early stage and wait for compounding.
Thank you, sir. Raju, sir. Dr. Raju. Okay, I'll ask questions. Next question is to Dr. Ramesh Shah. Which are the ideal scripts one should think of investing? What do you mean by large, mid, and small caps? Dr. Ramesh Shah, sir.
Yes, sir. Thank you very much, AMC, for inviting me to come for this wonderful webinar. Am I audible?
Yes.
Yes, sir. Yes, you are audible.
Yeah. My next question is to Dr. Ramesh Shah.
Sir, already asked. I have asked.
Okay. Okay. Yeah.
Now, I am almost always 100%. I keep certain amount fixed in my bank account in case something goes wrong. For next 20 years, my family will not suffer anything, and rest of the money is kept always in equity. I do it myself. Now I'll tell you how I do it, and that will probably help all of us to find out the way in which I have tried to do it, or probably better than me. Now, usually I always concentrate on events, certain things which are going to happen in next 4 to 5 years, certain announcement of government. Now, if you see in 2014, when Mr. Modi came in power, he said that he will give gas cylinders to everybody. So I waited for a year or two, and then we purchased confidential petroleum, which was a manufacturing of the cylinders. I purchased at 6 rupees and I sold out at 56 rupees. Then I took the concept of water. Now there will be a definite water shortage world over. And government is planning to supply water at everybody's house through a pipeline. So you need a clean water for drinking. And we do not have so many rivers to connect them. So ultimately we have to do something for desalination. We have a coastal area of 4,500 kilometers. So ultimately you will have to desalinate this river. Maharashtra government has announced about 3 months back 1,700 crores for desalination and supply the water to Mumbai. So similarly, all these desalination company or the water purifying company will be benefited. I purchased iron exchange at 300 rupees probably 3 years back. Today it is 2,500 rupees. I am holding a percentage in that, and I am not sold a single share till today. Iron Exchange has got an order of from UP government 1,000 crores. They got an order of 1,150 crores from Indian Oil, and they are getting many orders from all over the world. So that company should do well even from now. Third concept which I consider as the environmental problem. We have so many fires world over. So ultimately, these vehicles which are 15 years old, which they declared yesterday only, to scrap them. So I took the advantage of that thing about 6 months back, and we purchased one company called MSTC. They are the one who is going to scrap these vehicles for next 3 to 4 years. So they will be major beneficiary. So I had purchased at about 180 rupees. Now it is 250 rupees. The other thing is they will 100% ban the plastic one day. So we need to have a substitute of plastics. And one of the company which I have known very well is Uflex. They have already made the plastic which is biodegradable. What they have done is, in the plastic granules, they have mixed with bacteria which can destroy the plastic or melt the plastic in next 7 to 8 days after the implementation. I had purchased this share at 200 rupees. Now it is near 600 rupees. So these are the ways in which I select the shares. Some of the development which is going to happen internationally. The one script which I have taken a maximum exposure is the Kusum. Kusum is a concept which present Prime Minister has declared that they are going to supply the solar pump to all the farmers. India requires 3 to 4 crores of solar pump. And the only integrated solar pump company in India is Shakti Pump. I have purchased almost 4% in that company at 200 rupees. Now it is nearly 800 rupees. And I have not sold a single share so far. So these are the ways in which any development is going to take place. I wait for 2 or 3 years, buy the best of the companies, the industries, and keep it with me for 4 years. The next 2 years or 3 years probably you'll have the shipping industry doing very well. Because Mr. Modi, Prime Minister, wants the water transport to be promoted in a big way. He said that 80,000 crore they are going to spend for developing 400 plus port. Now, the only company which is the largest company for national sea transport, I'm not talking of the international, the national sea transport is Shreyan Shipping. I had purchased it for 110 rupees. I went on purchasing till 220 rupees. Again, I hold a percentage in that company. They have declared 4 times the profit than what they have declared in last quarter, the same quarter. The amount of money which we have to pay last year for transporting goods through the ship was $1,500 per unit, and that has increased to $9,400 today. So the shipping company, which is a national presence, are likely to benefit significantly. If you have this kind of concept, and if you're going to invest in this kind of concept and take up leaders in this company, then 10 to 20 times return in 4 to 5 years is very easy. So this is the way in which I always allocate my money. And at present, it is a time to put full amount of money into stock exchange. If you can do it yourself, you can easily do it. Most of us are very intelligent people. And if you start learning the few things, I think you can do it yourself. This is the message which I want to give you.
Excellent, sir. Thank you. Nihal ma'am, would you like to comment something?
I think I have had a presentation. You can just continue with questions to panelists.
Okay. Raju sir. Dr. Raju. Okay. I'll start with the question.
My next question is to
please.
Dr. Deshpande. Should doctors invest in startups or as angel investors in newer companies which are just rising? How to judge where to invest and how much to invest? Dr. Deshpande.
Yeah, there is a lot of excitement about this angel investing, and now that just like what Ramesh Bhai had said, that investing in a share. See, what happens is we always see only the successes. Angel investing is a specialty by itself. You must understand that. If you take an average success results, like treating a disease, 60 to 70% will die off, or most of these new concerns will just die off. 20% will just survive, and in 20% you will make your money in multiples. But for that, you need to know exactly what is the thing, and you also need to know the integrity of the promoters. The single most important factor while investing in angel investing is the integrity of the promoters and a sound business plan and a proper idea. You understand that? So which needs to make life easier. And in whatever way, I mean, it could be transport, it could be in, now particularly in artificial intelligence. In medicine, there is so much of artificial intelligence which is coming up, and the next Infosys is probably going to be from this particular line. But the thing is, nobody can plan to create an Infosys. Understand this. So what you need to do is you need to have a very, very clear understanding of that particular field. Just as somebody mentioned about Warren Buffett not investing in his best friend Bill Gates' company because he did not understand software, is a very living example of how you should and how you should not invest. And so don't jump into angel investing, and invest only that part which is not going to really hurt you. Like if your portfolio is say worth say 10 rupees, then don't go out for 88 rupees for these kind of angel investing. Maybe assign a certain portion out, maybe 10% of your portfolio for angel investing, identify the company, and then divide it in maybe about 3 or 4 companies with a clear understanding that 1 or 2 are going to be duds, absolute duds, which means that nothing will come out of those monies. You may invest 50 lakhs, be ready to lose that 50 lakhs. This is very, very important to understand. If you can't take that hurt, then I don't think this angel investing is a way for you to go. Then in that case, safely listed companies are very, very safe. Then why do people invest in angel investing? Is because the ratios of 1:20, 1:30 don't come in normal investing. You have to be very astute and very, very lucky investor to get these 1:4, 1:5 kind of multiples in a short period of time. Time is the single most important criteria for assessing your value of your investment. If I multiply my money from 1 to 2 in 10 years, I'm not really doing anything very great. But if I can do it in 1 year or maybe 2 years, then yes, it's a good achievement. So understand this time value. This is very, very important. So most angel investing will come through some kind of an investment advisor, and please look into it.
Thank you, sir.
Thank you.
Thank you very much. Raju sir, please.
I request to mute everyone except the panelists. There is a lot of background noise.
Yeah. Our next question is to Dr. Nitin Bhagali, sir. Proportion of balanced portfolio: land, property, gold, fixed deposit, PPF, mutual funds, and equity. What should be the proportion of that, sir? Dr. Bhagali, Nitin Bhagali.
Like Dr. Ramesh, I am also an equity man. But just to de-risk your portfolio, you must have allocation in each asset class per se. Gold, sure, it's the biggest hedge against inflation, and not more than 10% of your total allocation should be in gold. And again, in gold, I would not like to have possession of physical gold. It should be either in the exchange traded form, in exchange traded fund if my horizon is around 3-4 years. But if my horizon is still longer, then I would like to go in for sovereign gold bond. Now we also have an option of digital gold, but your total allocation should not be more than 10%. Real estate, of course, the yields in real estate at present have been very poor since 2008, 2009, and especially after demonetization and introduction of RERA and MAHARERA, all those things. But real estate, downward risk is less, but possessing it physically, taking due care legally is difficult. Rental yields of a residential property, unless it's in a tier 1, tier 2 city and in its good locality, is not more than 5%. Capital appreciation at present in real estate is also not more than 5%. And you have to consider again tax outgo. Apart from 30% deduction, standard deduction on a rental income, you have to pay normal, at your usual slab rates. Then coming to fixed deposits, it's a foolish investment because it degrows. It is better to keep your money in a liquid fund, and whenever you need it, you can withdraw it immediately. Fixed deposits do not make sense to us unless you are a senior citizen and put your money in senior citizen savings schemes where you have some tax benefit up to 50,000 rupees interest per year. So my choice would always be equity, because it's the only asset class which will really beat inflation, number one. Number two, there are ways now to de-risk or hedge your portfolio by having an insurance on a NSE or structured products where they ensure your safety of equity investment. So for me, at least 50, we are all doctors, we all earn very well, and for me, at least 50% of our total income should be invested in equity by everyone, because that will see you through to your retirement days. It will give you early financial freedom. You can afford to retire early. So equity is minimum 50%, 10% gold, and real estate. You should buy real estate which you are going to consume yourself. And if you are going to get some tax benefits by investing in a real estate, going for it. Otherwise, it is a very illiquid investment, very difficult to sell and realize what you aimed for. So, targeted price realization in real estate is really very difficult. So I always tell my friends, start early, give maximum corpus in equity.
Great, sir. Thank you, sir. Raju, sir.
My next question is to Dr. Ramesh Shah. Should one invest in high dividend stocks which give good yearly yield, about 15%, 20%?
Raju, sir, you are not audible. Let me repeat the question. How can doctors shortlist good shares? What is the criteria as per you to shortlist good companies? Dr. Ramesh Shah, sir.
See, once you select a sector, you always take the leader. See the balance sheet which is available on screener.in. There is a website called screener.in. There are many websites, but what I use is screener.com. Whether they are increasing their stake, that is the first thing. Second thing is, are they reducing the debt or not, or preferably a debt-free company. The PE ratio should be not very high, and there is definitely growth possibility for next at least 2 to 3 years. If you see all these things, once you select a sector, like suppose I select a sector of shipping, then I will see 2 or 3 shipping companies, which is the best of all, which is the best place, and how they have reduced the debt, balance sheet, in the balance sheet. And once you read that thing, it is not difficult, it is very easy. Then you can select the company. There are some companies where I have invested, I have taken, suppose I want to buy 2,000 shares, it takes 1 month to buy the 2,000 shares because there is no liquidity. But once the performance of the company is good, management is good, they are giving good dividend, their wallet, the liquidity automatically increases afterwards. Like in high energy battery, which I took at 160 rupees, if I want to buy 2000 shares, it takes 1 month. Now it is 1800 to 1900. So don't bother about this thing. Once the business prospects are good and going to remain for 2 or 3 years, and they have reduced the debt, they are expanded in a bad time. Like in Vardhaman Spinning, when I bought at 50 rupees, they have expanded much, much earlier than anybody of them. And now today the price of Vardhaman Spinning is 2000 rupees. So proactive management, reducing the debt, increasing the percentage of their holding, not pledging their own share, because once you're pledged, you're finished. The market will destroy you completely, as has happened in Macleod results and other things. They've gone down to 1 rupees and 50 paisa from 600 rupees. So when you see all these things are available on the net, and you can see is very easily. It is not difficult to do it. And then you select the company. It is very easy. It is not difficult.
Thank you very much, sir. Nehal ma'am, would you like to add something, comment something?
I think, what the panelists are doing, someone with so much of experience of actual investing over 30, 40 years, like Dr. Ramakant Deshpande said that he started his equity journey in 85. I'm very sure Dr. Nitin Bagali and Dr. Ramesh Shah would also have more than 3 decades of experience. So they talking with actually their experience of how they handled ups and downs and how they have built a psychology or thought process. It's something phenomenal, because we as financial advisors, though we try to train, but listening from the horse's mouth makes a lot of difference. So I'm very happy for the kind of knowledge which is coming forward. I think Dr. Nitin Bagali wants to make a point.
See, there are 3 F's which are very important for stock picking. First is fundamentals. Second, future prospects. And third is fair value. So all these 3 things you have to analyze. If the company is doing well, they're introducing new products, and future prospects look good for that particular sector, and because of government policies, you should focus on these shares. And the moment you feel that it's fairly valued, so don't look at the PE ratios. Opportunities will always exist in the market, even for a share of P of 57 like Bajaj Finance. You have to think whether you can afford to buy it, and if it's going to go up, why not buy it? So, growth is very important. Just PE is one number. You look at the growth in profitability, growth in top line. If all these things are good, and as Ramesh has already said, debt. Companies with low debt will survive even during adverse circumstances. So low debt, fair value, good fundamentals, and future prospects. These are the things one has to analyze.
Thank you, sir. Very nice. Raju, sir?
When I purchased Bajaj, can I
sorry.
speak 1 minute?
Yeah, please, please.
When I purchased Bajaj Steel, what Dr. Bagali said the same thing. When I purchased Bajaj Steel, the equity was 2 crores, prospects were good, price earning ratio was 1. I purchased at 100 rupees. Today it went up to 1300 rupees in a year's time. So these are the shares which I picked up, because I realized that the textile machineries and textile development is going to take a place in a big way for the next 1 year. So they are the people who are supplying the instrumentations and machineries. So I bought a Bajaj Steel. It is not belonging to Bajaj Group, but Bajaj Steel I bought it at 100 rupees, where the risk factor was 0. As Dr. Bagali told us, price earning ratio, depth, everything was practically 0, and it was available at 100 rupees. And it has become 1300 rupees. I hold percentage, and I have not sold a single share till today. So this opportunity comes once in 5-7 years, but when it comes, just hit them in a big way.
Yeah, thank you, sir. Raju Agrawal, sir.
I would request the panelists to be a bit brief, because so that we can cover maximum questions. My next question is to Deshpande. How do you manage your taxes? What are the basics a doctor should know about tax management?
See, the basic thing is, as far as individual, corporate taxes is a different chapter altogether, and individual taxes is completely different. So the taxation ultimately, you have to take a professional help in any case. That's why I think the organizational maintenance cost of the tax advisors, etc., also it does cost you quite a lot. But what you actually need to know is, essentially you need to know the difference between a long-term capital gains tax and your normal income tax. This is extremely important because you can build huge amount of assets by going through the stock market route, as what Ramesh Bhai also said. Because long-term capital gains, if you don't sell something, you don't make any gains on it, if you don't realize it, then you can have multiple times. You can have that, what he quoted, one share of 100 rupee going to 1300, it may go to 13,000 maybe in another 5 years. You never know. Let's hope that he makes it that kind of a thing. But till he sells it, I have seen 13,000 kind of a rate for ECC as well as for Infosys. But till you sell it, you don't pay even a single paisa tax. And that's why this multiplication, compounding is something which is extremely important. So while understanding taxation, ultimately, how much can you really plan your taxes? I don't really invest too much into tax saving kind of instruments. I would not see the PPF, everything is all compulsory thing. I always use those things. But there are a lot of these tax minimizing kind of strategies where you block your money for three years. It doesn't really make so much of a sense to me. If I sell a property today, suppose 1 crore of rupees, what is the tax implication? Long-term capital gains may be about 17, 18 lakhs. It's a lot of money when you look at the whole picture. But if you invest that remaining 80, 85 lakhs properly in a stock market, in the next 3 years, when you're going to get maybe about 1 crore, 10 lakhs, you will probably be at least about 1.5 crores or 2 crores, even with proper investment advice in the stock market. So I utilize every rupee that I have properly and then invest it in proper kind of a market. That is what it is. As far as taxation is concerned, all the advisors which are there, tax advisors are there, your chartered accountants are there. You plan as much as possible. But beyond that, I don't really attach too much of importance. I'm very aware, I'm very sensitive to the changing rules of income tax as well as to that of the capital gains. I pay my taxes very, very carefully. There's not even a single rupee in cash which is generated. This is extremely important for every doctor to realize. Please understand that the money which is there in your locker or in your table drawer is of no grade to you. 100 rupees in your table drawer is worth not even 1 rupee in your bank. This is extremely, see, what you are also doing, I'll tell you, is you not only are adding to your strength, you're adding actually to national economy. That's a productive asset. Every rupee which is coming in is actually a productive asset. And it is giving fillip to your industries, your countrymen, your stock market, everything. And that is how actually the compounding will keep on happening. So attend to your taxes very diligently. Please make sure that you pay them in time if your cash flow is good enough. And just take expert help. So that is the only way to deal with taxes.
Thank you, sir. Thank you very much. Next question is to Dr. Nitin Bhagali, sir. What are good books to read, newspapers to read, and news channels to watch to learn on investments?
I'm a very poor reader. What I read really is, Business Line, which is a newspaper of Hindu, which comes daily to me. Economic Times sometimes, especially their Investors Guide on Monday. Business Line Sunday portfolio, their edition, I read very carefully. I love it. I read Dalal Street Journal and I read Capital Market. I have not read a single book written by any giant investor, may it be Warren Buffett, or I just keep on hearing names from various colleagues on various groups, but I have never read them. I have done my own study, consulting my chartered accountant friends, my late father-in-law, and I have developed the art of reading the annual reports myself. So what books I read most commonly is annual reports of the companies. That's number one. Number two is Business Line, and number three is Dalal Street or Capital Market. That's it. And I would strongly recommend, if you want to develop your own art, go on the net. There are so many articles how to read a balance sheet of a company, how to read a profit and loss account statement, how to read a cash flow statement, and it's a matter of just 3 or 4 days. Then you start practicing reading annual reports. Annual reports are easily available on the net nowadays. Even if you are not an investor, it's not difficult to access them. And you start building your own mock portfolio for a year or two. And once you are confident, yes, your knowledge is gaining and you are doing better with your mock portfolio, you start investing directly.
Thank you, sir. Next, Dr. Raju Agrawal, sir. Dr. Raju Agrawal. Okay, I'll ask the question.
My next question is to you.
Yeah, please.
I'm there. Should we invest in high dividend stocks or stocks which give good yearly yield on investment?
Dr. Rajiv, that question has been asked before by, I think, to Dr. Ramesh Shah, just the last question.
The stock option trading and future trades. What do you say about that? Should doctors indulge in option trading and future and options?
Are you asking me, sir?
Yeah, Dr. Ramesh Shah, sir.
I think you should never indulge into futures. Never.
Yes, sir.
Doctors or anybody, I would say, never do that. It leads to unnecessary stress, one, and you don't know once you start doing it, it becomes an addiction. Then you cross your limit. Because 10 रुपया देके 500 से ले सकते हैं. And then it becomes an addiction. I have never seen anybody making money in future and option. I have never seen. Don't do that. It's not for us. We are not speculator. Even if somebody tells you hedge fund, either say hedge karo, udhar option lo, don't do that. It never gives you money. You better put that small amount, whatever you have, invest in an equity, wait. If you cannot do it yourself, tell somebody else to do it for you. But never indulge into this future and option. I have never done in my life. I will never do it. I will never advise anybody to do future option.
Thank you, sir.
Dr. Trivedi, I will want to add to what Dr. Ramesh Shah very nicely said. We in finance very commonly joke that futures and options are instruments of mass destruction. Okay. And I will say that trading is a profession. Okay. I know options because I've been studying finance for 2 decades. I have used options to hedge portfolios for myself. But if you ask me, do I indulge in futures and options right now? I don't. I have a full-time work to handle Finovate, to look at people's portfolios. I myself don't get time to do any trading or options or anything for myself. So I will say that your profession is something different. Trading is a full-time profession, and futures and options require a lot of deep study. And even after a lot of deep study, I know of very big hedge funds and a lot of fund managers where at times the calculations go wrong. So why take so much of stress? Why not just be passive investors? You can create so much wealth by passive investing. Like Dr. Ramesh Shah said, I don't know of any big investor who has been created out of trading and futures and options, whereas I know a lot of big investors who have come out of long-term passive investing, which is like Dr. Ramesh Shah, Dr. Nitin Bagali, and Dr. Ramakant Deshpande, and many more doctors who actually invest in markets for long term. So I feel that passive investment strategy is the best for medical practitioners. Though there have been many groups which have been training people on technicals and have been training people on options and trading and all that. But at the end of the day, who has that much time? So you have to weigh it against the time and against how much is it going to add value in the long run. Like if you are putting a certain amount of capital to trading, and if that capital double triples, how much difference is it going to make to your life? You will only put a small amount of money in trading. Why take so much stress and put so much time in handling that? Instead of that, like Dr. Ramesh said, that buy good companies and hold it for long run. There is no better wealth creation with less time involvement and less stress and headache than long-term investing.
Thank you, ma'am. Raju sir, next question to Dr. Deshpande sir. Dr. Raju Agrawal.
Yeah, what is your advice on doctors? How do you think they can get financial freedom?
For the doctors?
Yeah. What is your advice to doctors?
I think in the beginning itself, you defined that, right? Financial freedom is a state where actually money is making money for you rather than you running around for money. Please understand one thing, as Nehal also brought it very nicely, that you need to define what you actually want to do. What is your passion? If your passion is medicine, do the medicine, whatever you're generating, invest it appropriately. Now, everybody has an appetite for investing in equity, appetite in investing in fixed deposit, real estate, whatever it is. Choose it very carefully. Understand what are the side effects of every kind of a choice, what you have. Because if you say I'm going to, I'm very comfortable only with real estate, and then if you're going to look at it, then I think Dr. Bhayali has already mentioned that yes, take your rent, which is like 2% of the whole net worth of that particular property, and then you give 30% in income tax, 10% in your repairs, and then whatever remains is what you're going to get. So is that going to make you financially free? Not necessarily, but your property worth, yes, my property worth is going up, but it is worth it only if you sell it. If you don't sell it, it is not of worth much. I'm a Maharashtrian, so in Marathi there is a saying which translates like, जब आप खाने के लिए नीचे बैठते हैं, तो नीचे जिस पार्ट पे आप बैठते हो उसकी कोई कीमत नहीं है, भला वो सोने की हो या कुछ भी हो. सामने वाला ताट अगर सोने का है वो बेच सकते हो. So your investments you can actually sell. But if you got your house worth maybe 100 crores also, it is worth zero for you because you're actually living in that. So you need to have your priorities very, very clear what you want to do. So generate, you have a master plan, have a patience, have a stability, and all these particular, like you need to have a projection. Like if you require suppose for good living, you need about ₹1 lakh a month today. 20 years down the line, it's not going to remain at 1 lakh. How much it's going to be? You can either do the calculation yourself or take help from somebody like say Fincon. They'll work out everything for you for all the projections. Do you need a term life? There's that. So essentially, you will become financially free only when your headaches regarding finances totally disappear. Your generation of revenue, whether you are there or not, will continue for the rest of your family, and that is the time your headache for worrying about money will completely disappear. Now, happily enough, I only hope that your family doesn't realize that ये बूढ़ा है या नहीं है तो भी हमारा ऐसा ही चलेगा, अच्छा चलेगा. That stage should not come, but your target should be that that your family should be well looked after even after you're gone. So that is the state of financial freedom.
Thank you, sir. Thank you. Next question is to Dr. Nitin Bhagali, sir, and that is doctors and rental income. What is your advice on rental income?
As we have already said, rental yields in India at present are not very great unless your property is really situated at prime commercial or prime locality, either residential or commercial. Then the costs are not going to be cheap. So your rental yield in a residential property, pure rental yield is never going to be more than 3.5%, and for commercial property 7 to 7.5%. So according to me, whatever rental income you are going to generate, you are going to get 30% offset as standard deduction, but you are going to spend that money on maintenance and renovation later, because once your kirayadar is going to vacate it, it's not going to be in a shape to lease it out again. So you have to spend a lot of money and again on the renovation. So instead of relying on a rental income from properties which are not going to be in prime locality and yields are going to be poor, better avenue I would suggest is real estate investment trusts. So they are getting listed on the stock markets now, and they are supposed to, SEBI has enforced regulation that 90% of their profit they generate should be distributed back to the unit holders. So that's a better option. REIT, real estate investment trusts. If you want to retire and rely on, regular income, see, any asset class will either give you a regular return plus capital appreciation. Your real estate property will give you some capital appreciation, but may not necessarily give you great rental yields. Real estate investment trust is one avenue where it will give you geographical diversification, locality diversification. It will reduce your group of investors will be pooling their money together, and it's like a real estate mutual fund where the expert fund manager will invest your money in prime commercial properties across the country and generate income for you. Real estate investment trust will be a better alternative than a rental income.
Thank you, sir. Thank you very much. Raju, sir.
My next question is to Dr. Ramesh Shah. when to sell shares? What is your advice? Means when do you decide ki now this is the right time to sell this particular script?
Now, this is one question which is little difficult to answer because everybody's risk appetite is different. I have a very high risk appetite, but on an average, I can tell you that if you purchase about 2,000 shares at about 100 rupees and it has gone up to 300 rupees, at least 30% of the shares you should dispose it of so that your basic cost is recovered. And then you can wait and take the risk whatever way you want. The moment the business cycle changes, I think you should dispose of all of them. There are certain times where it is not easy to dispose because of liquidity problems. So in those kind of companies, you should not have huge stake because then it is very difficult to buy and very difficult to sell also. But if so many people ask me, that आपने बेचा क्या? मैं बोला वो जवाब मैं नहीं दे सकता हूँ क्योंकि आपकी रिस्क एपेटाइट अलग है, मेरी रिस्क एपेटाइट अलग. आज मैं आपको बोलूंगा कि आप बेच डालो and then the price goes up, people put the blame on you कि तुमने मेरा सब शेयर बिकवा दिया. So the ideal time is to take out your basic amount, what you have invested in a specific script, take it out the money first, and then you can play with the rest of the shares which you have, and gradually every rise you go on disposing little amount. Don't try to catch the bottom and the high, the top. Don't try to catch. आपको बेचने के बाद में दूसरे को भी कमाने दो. If you have this kind of concept, no, you will not regret.
Yes, sir. Thank you, sir. Nehal ma'am, would you like to add something, comment something?
In fact, I think this is a very good question that when do you sell your shares? So I think we should ask Dr. Nitin Bagali and Dr. Ramakant Deshpande's view also on this with their personal experience. Like when does Dr. Nitin decide that he wants to exit a company? What is his criteria?
Selling the share as the price rises, as Dr. Ramesh has just said, that's a thing which I have learned recently from my group. There is a there is a group of friends. They keep on holding only free shares in their portfolio. The moment their share prices go up, they sell their basic investment and keep only free shares with them. So they have a portfolio of only free shares, which I have never really done till today. I have been a very patient and long-term investor. I do not sell my shares unless there is a major problem with the company, management of the company. If their product fails to do so, do better, and ultimately what is most important is how the market perceives. It's the market dynamics which decides the price of the share. So the demand for the share, irrespective of the performance, comes down. Say like ITC. ITC has been steady there for many years, despite good performance and big kitty in their reserves. The share is not in demand. So I have liquidated 80% of my holding in ITC, still holding only 20% with the hope that the fortunes may turn around and it will grow. So I sell my shares when the performance is poorer. There is a problem with the quality of management. They have done some fraud or some other things. There is an increasing competition and their technology is becoming redundant. So these are the cases, indications where I sell my shares. If there is a big dip in a certain quarter, I sell them. But I am not that impatient. Just by one quarter result, I sell the shares. I still hold on for another quarter or so to look whether it's turning around and if the basic fundamentals are not getting disturbed. The moment I feel the basic fundamentals are getting disturbed, cash flow is reducing, their operating profit margin is going down. One of the most important, criteria for me is I study their profit margin, operating profit margins for last 5 years. And if suddenly there is a dip in the operating profit margin, maybe because of increasing raw material prices or their power bills or whatever reason may be, decreasing profit margin is a big indicator for me to sell shares.
Great, sir. Thank you. Next question to Dr. Deshpande, sir. Raju Agarwal, sir. Dr. Raju?
Yes, sir. Hello. Can you hear me?
Please ask.
What legal structure would you advise to doctors and how should they make changes in the legal structure as they are growing?
The best thing for this is actually it all depends upon your extent of the size of your practice and your infrastructure that you want. If you are an individual, then I think individual practice itself, ownership based kind of a structure is more than adequate. And that can go up to nursing home sizes of even 20 or 30 or even up to 40. If you have a partner, then obviously a partnership structure with clear-cut, delineated these things. But what happens, I'll tell you, is where do actually the fights come up is when you have a partnership structure, you're trying to put all your practice money also into that particular partnership and then trying to look into what exactly is happening. See, there is a structure, there is a physical structure of the partnership which owns that particular asset of the nursing home or whatever it is, based on whatever is the individual investment that what you have put. So the best thing is to keep your individual practices separate and to keep the organizational revenue completely separate and then to split it, rather than putting your all practice money also inside and then getting mixed up and then saying, oh, I have put all my money, I have not taken out, and then there is a fight at the end of it. And if you have a large structure, say 100 beds, 200 beds, multi-locational hospital, then obviously a limited kind of a company will automatically make much better way of investing. And that obviously needs organizational advice, legal advice, chartered accountants, and so on and so forth. So we need to decide also what is the extent and the size of our practice and what we want to do. One of the advantages of having a limited company, a private limited company, is it's transferable. So suppose you have a big hospital, which has a large structure of say 1 lakh of square feet, so on and so forth. The transferability, if it's an individual name or something, it becomes a little difficult, particularly if one of the promoters or the partners dies off, then it makes a major mess. So then in that case, if your structure is big, better get into a private limited or maybe even a limited company kind of a structure. So everything will depend upon the magnitude of your practice and the way you want to go forward.
Thank you, sir. Thank you. Next question is to
Ramesh Bhai wants to say something.
Yes, Pandey sir, what is your experience with LLP, limited liability partnership? See, two people can join the practice.
Yeah, you are right about that. Most LLPs will be used with a clear-cut objective of dissolving them at some stage or the other. So if you have an objective, for example, if you want to become a partner and then if you want to eventually absorb that LLP into a limited company, then it becomes easier. See, being doctors, you are not protected from your legal responsibility towards your patient. But the hospital will be, you can actually protect your house and hearth from that particular problem if you have a LLP structure. So we don't have any LLP structure because it has come fairly recently, I would say, though it's been going on for like more than 10 years now.
Now, what is happening in that is that in LLP, the surcharge which is supposed to be around 20% to individual gets reduced to 10%. So you save a lot of tax on it. Dr. Begani, can you give some idea about this? Dr. Nitin.
Yes, of course, there are tax benefits. I have a lot to say on this structuring of your profession. See, I run a small hospital of 20 bed strength. We have 2 other hospitals run by my daughter. But we have structured our profession in such a way that, once your income goes up beyond 2 crores, your tax liability increases remarkably. So your tax rate comes to 36%, and if your income is above 5 crores, then it is going to go to 42 point some percent, 42.75%. So how we are going to reduce the tax liability legitimately? Create as many legitimate taxable entities as possible. See, as an individual, you are a doctor, you are going to have your own consulting business. If you are going to have your consulting profession, you can avail of 44 ADA tax concessions if your professional receipts are limited to up to 50 lakhs a year. And normally as a consultant, our professional receipts as a consultant will remain around that figure only. So you have to just declare 50% of the profit of what you have received as a proprietary concern and pay off 50%, pay off the tax according to that 50% 44 ADA condition. No books of accounts are required. There are no scrutinies and no questions asked. Your hospital can be owned by your other family members who need not be doctors. Your pharmacy, your physiotherapy clinic, your diagnostic wing like X-ray or lab can be managed by your HUF, your non-medical parents or your non-medical spouse. If your wife is also a doctor, she can avail of 44 ADA for her consulting practice. So yeah, you have to create as many entities as possible and reduce your tax outgo, which we have done very effectively. In my orthopedic hospital, we have a decent patient footfall. I have a diagnostic wing which is owned by my HUF, and it generates a lot of revenue. But the tax outgo is, it gets divided, and my gross income annual becomes, less, and overall surcharge, cess, everything becomes less. And in addition, you get usual tax concessions for initial slabs. So that's how you should plan.
Thank you, sir.
Sir, I would like to add something here. When you are partnership and LLP is always better, but the taxation in LLP is almost 30 plus taxes, whereas in private limited company the taxation is 22% now. So 8% less plus the surge. Yeah, 20. It comes to 25, 22 plus surcharges and all. So it comes, whereas the LLP and partnership firms, it comes to around 33 point something. So if you're having a private limited company, you still end up saving 8% tax on your gross net revenue. So that is also one thing we need to look upon, where you are having a good volume and good profitability. 8% is a big amount. You can invest that in shares, and it can multiply.
Next question is to Dr. Nitin, sir. How to track your portfolio, ideal number of stocks and mutual fund to invest?
Theory is different and practical is different. People say you must have not more than 20-25 stocks in your portfolio, but I have never followed this. I have used, I have a big portfolio with more than 150 shares in my family holding, but I am able to track them very regularly. I track them almost every week. Closing prices for that week I study, and it's not that difficult once you get used to handling your portfolio yourself. And as far as holding limited number of stocks is concerned, see, there are two types of stock. One is a growth stock and the other is a momentum stock. Don't bother about the momentum stock. The moment you reach your targets, you can sell it off and never feel bad, never get attached to that share. But there are certain stocks which I call as growth stocks, which you are going to keep in your portfolio for a very long time, maybe for retirement. Dr. Ritesh Agarwal, who is here amongst us today, he has designed, he has calculated fantastic method of how to ensure your retirement holding 20 or 10 stocks in your portfolio, which will give you a CAGR of more than 25% per year. And there are quite a few stocks they are giving more than 25% CAGR in price over the years. And he has calculated putting 30 lakh rupees in these blue chip growth stocks and holding them for 20 years will generate you a profit of more than 1 lakh rupees every day after 20 years, despite ups and downs, assuming that there are 250 trading days in a year. I'm really impressed by that calculation, and I can give that advice to my younger generation that it's really a good idea to spot these stocks, these 20-25 stocks who are showing you a CAGR of more than 25%, and block your money there and wait for 20 years. You will make a decent profit for your retirement.
Good, sir. Thank you. Raju, sir, next question.
Thank you, sir. Next question is to Dr. Ramesh Shah. How risky is investing in stock market? And what should a doctor do when a share he buys goes down? Should he book losses or exit, or should he average when the stock comes down, or buy on dips?
The stock exchange is always going to be the risky factor. In about near 2000, even the Tisco went down to 90 rupees. But nobody thought that it is going to become 90 rupees. So stock exchange, investment in stock exchange is always going to be risky. Today you buy something, some wrong event occurs, it can fall down. But if you are very confident that it will bounce back, you need not get worried about it. So any risk appetite person only, they can go directly. Otherwise you have to go through the mutual fund only. Now, coming to the fact that the prices have fallen down, will you average or not? I will never average unless I am very sure of the performance. There is one company which I can give you the example recently. That was a Shakti pump. They had a problem because of the pandemic. They could not deliver the pumps to the farmers because there are a lot of restrictions. Last quarter results were poor and the prices came down from 900 to 650. But I did not buy, neither I sold any shares. I kept it as it is. Now it is around 750 because I know the growth story is going to be very strong in next 2 to 3 years. So you have to understand the business also, the performance of the business, what they are likely to do, whether they have going to have the same market share. Now, Shakti Pump has almost 80% market share of the company. And by the time the next company comes inside the country, it will take 2-3 years. So they have near monopoly. So if I'm very confident of this kind of company, then only I will invest in a big way. So good management company, usually they bounce back, but a poor management company, if they have done a pledge or they have done something nonsense, they've taken too much of money, like what Vodafone has done it, then I don't stay. If I feel that I have made a mistake, I get out at the loss also. There are one companies where we have made a loss of huge money from, say for example, on 180 rupees, I sold at 4 rupees. And then company got delisted. So these kind of things do happen. But most of the time now, in recent last 4-5 years after learning everything, and most important, doing yourself. नहीं तो क्या होता है, जो रास्ते मिला ये ले लो, वो ले लो. And then you lose the money. You study yourself. We are all intelligent people. We understand more than any other people. Once you study or ask some friends, Dr. Begal is there, Dr. Deshpande is there, they can help you out to understand the company. And then you can, I don't think there is any disappointment in most of the cases.
Thank you, sir. Thank you.
Thank you.
Nehal ma'am, would you like to add something?
Yeah, I would like to add to this that averaging is very dangerous. Like Dr. Ramesh Shah said, that why the stock price came down, you need to understand the reason. Is it just that the company is going through a bad business cycle, or there are external factors like COVID? In COVID, there were good companies where the earnings went down and the stock prices came down. But that doesn't mean the company was bad. Okay, so averaging should only be when you're confident that the company has just gone through a bad business cycle, or there was an external event because of which the earnings have dipped, but fundamentally the company is still good. So then in that case, you can add that company on dips, like I had said in my presentation. But I've seen a lot of doctors catching a falling knife. Like they bought a stock at a certain price, it's become half, so they keep on buying more so that the average price comes down, and in a hope that it'll go up. Like this happened very rightly with Vodafone. People have gone on buying at all levels, expecting that they will get an exit. So you should look at fundamentals before taking a decision to add that company on dips. And like Dr. Nitin Bhagali said, that it is at the end of the day earnings and the quality of earnings and the margin. Like if the profit margin is falling for a company, there is a reason why it is falling, you know. So these 2-3 numbers is very, very critical. And at the end of the day, it is just the quality of earnings which will matter. The growth, like Dr. Ramesh Shah said, the growing companies or the growth which will matter when taking the decision to first buy and then add when it is dipping.
Great, madam. Thank you, ma'am.
My next question
Raju,
is to
sir.
Dr. Deshpande. Which asset class investment has, my question to Dr. Deshpande, which asset class investment has created maximum wealth for you, and what is your prescription for wealth creation?
Well, the prescription is only patience and certain amount of discipline. One more thing is never be carried by greed or by fear. If you're in stock market, I think these two things are the most dangerous thing. You know, there should be no greed and there should be no fear. Just as what Ramesh Bhai said, even if it goes down temporarily sometime, don't try to sell in a hurry. Otherwise, you'll always find that people are selling when it's at the lowest and buying when it is at the highest because of the greed. So that formula should never be done. You have to have a certain amount of discipline, right? From suppose you start your practice at say 30 or 32 years of age, your requirement probably would be maybe around 50-55% of your income. Have a complete discipline that a certain percentage of income must go into investments. This is very, very important. Then don't try to become a multi-billionaire in just about 3 years or something. Very likely you are going to lose all your money, whatever you have. So best thing is not to do it. It will happen. It will definitely happen. But it will take its own time. So discipline is something which is very, very important. Now coming back to what has really made me the maximum amount of my net asset value, it is the stock market which has actually helped me and stood by me through thick and thin. But mind you, from 1986 till now, I have seen 3 ups and downs, and they have been such drastic ones that they are good enough to make anybody lose hope and take drastic actions, which fortunately I did not really do anything really very, very drastic. But theoretically, if you really analyze, if you can just modulate that, if I had done this, if I had done that kind of a thing, it's not so easy to work out a portfolio of 100 crore or 1,000 crore or even a 10,000 crore. If you had bought ACC at 100 rupees, sold it at 1,300 rupees, and so on and so forth. If you keep on doing all that therapeutic, those models, it is easy to see what can actually happen. But when you see what can actually happen with that kind of a faith, then you realize that yes, if I have a little discipline and if you have a little bit of a patience, I can actually make fairly decent amount of money. If you are making, today inflation is maybe around 6 or 7%. There was a time when it was between 9 and 11%. If you are making your money every year, double that every year, if you're doubling that value, then over a period of 30 years, you are likely to go up by maybe about nearly 100 times. So it is a huge amount of increase. 30% compounding, if you have every fourth year, you are doubling your money, which is not easy. It's very, very difficult to double your money every 4 years. Ramesh Bhai said that yes, in last 1 year, he may have given some example. It doesn't happen in every share. So if you take a entire portfolio value, if you are able to double it within 5 years safely, then in that case, 25, 30 years is what you're looking at to get a very, very substantial kind of a sized corpus, no matter where you start. So stock market is a place to be definitely in. There is no two ways about it. You can't really escape this elephant which is there in your hall. And please get to know that, because this is a language which you must understand. So that is what I would like to be.
Yeah, thank you, sir. Next question is to Dr. Nitin, sir. What is the right valuation price to buy shares? Is trading good to make my money work for me? And what is the prescription for wealth creation? Take home message, sir.
Start early, be patient, read. Knowledge is the most important thing, not only of stock markets. You have to upskill yourself in your profession as well, so that you generate more revenue to get you to invest it in the stock market. So both the things have to be complemented. Concentrate on your professional upskilling as well as reading about investment science, and develop an art to invest your money shrewdly. Be patient. Enjoy the fruits of compounding. Never borrow more than what you can digest, just because of peer pressures. Now there is a tomb in Pune that every joint replacement surgeon is going to getting a robo which costs nearly 6 crore rupees. Are they really going to generate that kind of revenue to repay this sort of investment? Pune is the biggest only city in India which is having 5 robos now for joint replacement. So all these things are amazing. You have to be really very practically intelligent. Put your money which is going to get you returns and get you decent returns. Do not believe in miraculous stories. Be practical, be wise, be prudent, learn to save your taxes, and enjoy the fruits of your patient investment. Now, right valuation. Valuation is always a perception. There are, all these ratios are just numbers. But what you have to analyze, that company is making profit, it has a positive operating cash flow, it has sufficient money to pay for the, repayment of the debt, what we call as interest coverage ratio. It should be more than 2. Its PE ratio should be around 20, even if it's around, say, 30. But if it's making more profit than what its PE ratio is, that is growth in its net profit. So PEG ratio is also very important. Then study its return on equity as well as return on capital employed. Its ROE and ROCE should be around 15% plus. There should not be too much of difference between ROE and ROCE. That means if your ROCE is distinctly more than the ROE, that means the company is paying more to the lenders than the equity holders. So you should always observe these facts: rising sales, steady profit margins or rising profit margins, good interest coverage ratio, a decent PEG, and a free operating cash flow. These are the scripts which you should put your money in, and over a long time they will give you a financial freedom. You don't have to work anymore for a living.
Thank you, sir. Next question, Raju sir will be asking. That is the last question.
Sir, what is your take on wealth? What is your take on wealth creation, Dr. Shah?
Can you repeat the question? Because
yeah, I'll repeat it, sir. I'll repeat it. What is the prescription for wealth creation? Something like take-home message from you for us.
See, take-home message for the next 2 to 3 years. I think we should take a little risk and invest in stock exchange, either directly or indirectly, because next 2 to 3 years, this country is going to do very well. We are best placed today in the international market in almost everything. Invest in a industry which is likely to grow very well, like water management, Kusum Yojana, that is the solar pump, then shipping industry, artificial intelligence, cloud storage. All these things are, even the software industry is likely to do extremely well for next 4 to 5 years. So select your company, whatever you like it, do it first you start with the indirect one and start learning yourself. That will help you to create more wealth. And I think it is a time to take the little risk and invest in stock exchange directly or indirectly.
Thank you very much. Thank you very much.
Thank you, sir.
Nehal ma'am, would you sum up everything?
So I will say that the takeaway from this session, like we say that the wealth prescription is that you should get your asset allocation right. That is what every panelist and every speaker said, that you should put in equity. You should definitely have some reserves in debt for bad days, like some portion in real estate, how much you can consume or use, and little bit in gold as a hedge against bad times. So asset allocation. Then the second thing is regular investments. You cannot invest one time, like you're earning every month and as doctors every day. So regular investment is going to take care of volatility or ups and downs in various asset classes. And the third is the power of compounding long term. How much ever said about long term, the less it is, because people in theory understand long term, but when they are practically investing, they start judging the market and looking at the levels and ups and downs and switching. So I think the more said about long term, the less it is. The power of compounding will only work when you stay invested 10, 12, 15, 18, 20 years. And like everyone said, tremendous wealth can be created by just one thing, which is power of compounding. In fact, nobody can give returns, nobody can create wealth. I have been in industry for 2 decades. I cannot say you will get this return or guarantee any return. Nobody can guarantee return. It's the markets which guarantee, and not even markets. It's the power of compounding which will create wealth for you. Okay, which is a concept which makes you to stay invested for long run. So this is what will be the closing remarks, and all over to you, to the committee of AMC.
Thank you. Thank you very much, madam. I thank Dr. Nitin Bhagali sir, Dr. Ramakant Deshpande sir, Dr. Ramesh Shah sir, Dr. Ms. Nehal Mota ma'am. President ma'am, can we shall we can we take some more questions, or shall we finish it off? President ma'am, Dr. Bhatnagar madam.
Yeah, I think we should close. It's past 2 o'clock. So we have done very well. And this is the first of the series. So we will be doing more and more of these sessions. We've also started the Telegram group, the AMC Financial OPD Telegram group. And our discussion can take place even in that group. And as everybody has said, that we need to keep reviewing the situation from time and again. Meaning invest, yes, but we also need to review. So we will catch up one more time, and we can close for today with many, many sincere thanks to all the speakers and the panelists who have done absolute wonderful job for educating us. And also just one thing which keeps coming to my mind is my father had done a lot of investment in equity, and in fact he was investing just 5%, 10% to begin with. Later on he started investing more, and today I'm realizing the importance of what he did and what he handed over to us, as a legacy that he has given. Hats off to all of y'all, to all the speakers and panelists, and I hand over to Dr. Jayesh Shah.
1 minute, Dr. Jayesh Shah, there is 1 minute. 1 minute, Dr. Jayasha. There is a request for Dr. Narendra Dedia. He wants to just, come in and speak for a few minutes. So I think we can just hear him out. Dr. Narendra Dedia, I saw your message in the chat that you wanted to come in for a few minutes.
Is he there or has he left?
No, I'm there actually, but can you hear me?
Yes, yes.
We can hear you.
I think, Dr. Bhatnagar, congratulations to you for the bringing out this financial freedom. In fact, that was a very, very, very close topic to me and then very close to my heart also. I had gone through in my life so many things. I'm not going to discuss that part here because there is no time and people wants to go. But here just that last, whatever the summary people wanted to get, and I just wanted to add a couple of points there that it's very, very clearly, I think Mr. Nimesh had mentioned that you don't require high intelligence, and I absolutely agree with that. In fact, that is a what going to give you a problem. अगर आप कुछ करने जाओगे ना तो तकलीफ होगा. You have to simply select the good script and sit. Do nothing. Yes, by doing that, you will not get the kick, but at the same time, you will get the extremely good return. Believe me. So that's the most important point. And stock market equity, what it requires is a simple thing that absolutely discipline, no extra intelligence. In fact, friends, I will tell you that you don't require to know the so many things which probably the technical people will tell you do this, do that, those parameters. Yes, yes, if you know that, that will be excellent. But if you don't know, don't worry. I think what you need is a simply understanding that compounding factor, which everybody had said, and I strongly will tell you that that is the most important thing. Time factor is the most important part, and we have to give a time for the company to grow, company to give a results. And there are so many examples which I can give here, but time is the thing. So be simple thing, that be simple person. Don't use the much brain. Anything if you want to do the, many people go into the hearing somebody and go for a in between small things like trading or buying the penny stock. Only one cautions I will tell you, that now we are in the bull phase of the market. So be careful. Yes, equity is always good, but bull phase of market is always makes you that what happens that suddenly suppose the correction comes and so many people then run away from the market. They will say that stock market is a satta market. They don't want to be in the part of that. They will always give gali. They will always say that yes, market has been manipulated. Yes, those days were there. But now the SEBI is definitely much more active, much more vigilant. And in fact, few rules of the SEBIs are so strict that to manipulate the market is not easy. Yes, there is inside information and something which goes on, but you have to be very, very careful. Today, I will recommend some particular stock, but you must use your brain whether to buy or not to buy, because it will not be possible when I am exiting you, whether you will be exiting or not. So these are the few important points. So that's why what Nitin had also said, what RC also said, and what Ramesh said, it's very important that you select the proper stock, be with that, sit quietly and just enjoy. In fact, sometimes there is a lots of fluctuation in market and you are very confident. You invest more, otherwise just enjoy and go on holiday. Thank you. Thank you very much.
Dr. Vivek Dwivedi?
Yes, sir.
Please hand over the digital certificates to the panelists before I give a concluding thing.
Yeah. Please accept digital certificates.
Dr. Nitin Bhagali.
Dr. Nitin Bhagali, sir. Dr. Ramakant Deshpande, sir. Dr. Ramesh Shah, sir. Ms. Nehal Mota, ma'am. Thank you very much.
Thank you very much.
It is my honor to present the digital certificates to Dr. Rajiv Agarwal and Dr. Vivek Devidi, sir. They have moderated the session in such a nice manner that we are much wiser now. So now after conclusion of this panel discussion and the program, I hand over the mic to Dr. Jayesh Shah, who will give the vote of thanks.
Thank you, Dr. Ritesh. I'd like to thank our President, ma'am, Dr. Shushmita Bhatnagar, and Finovate, our financial partner, who has made this event possible in the first series of our webinar, Financial Freedom. On this Independence Day, it was really a great beginning to us for having ourselves be financially independent to ourselves and to our family. And hope this series will give further knowledge to all our participants who have joined in a very large number. We will try to make this available on YouTube so that you can see yourself again. And thank you very much, everybody, for joining this webinar. Thank you very much. Thank you, President ma'am.
Thanks.
This has been really, really wonderful. And I'm sure our journey, which has started in educating and in giving financial freedom, is going to continue. It's not a one-time effort. And I'm sure many will join the masterclass also. We are looking forward to having people giving their best shot, meaning not facing financial troubles when they are having their own hospitals, nursing homes, institutions, managing their business finances and all of this. Thank you so much. So have a great time today. Relax, enjoy, and happy Independence Day to all. Bye-bye.
Happy Independence Day to all.